So today we will be studying returns assessments and administrative compliances. Naturally, procedural part of the UAE corporate tax law is as important as understanding of it. So in this module, naturally, today's learning objectives will be to understand the bookkeeping, financial statements, taxes payable, refunds, administrative penalties, and various powers that have been conferred to the Federal Tax Authority. Will be understanding a little bit more about tax procedures, law, and executive regulations. We'll be able to identify and ensure compliance with the procedural compliance of the corporate tax law, and we'll be able to explain about the procedures, how to simplify the tax administrative procedures, and how to file returns. First of all, we need to understand the powers that have been delegated to FTA that has been addressed in Article 62 of the corporate tax decree law. So what is the jurisdiction of Federal Tax Authority? Now, Federal Tax Authority was established in 2016 under a decree law number 13. So let us have a look at various things. What does FTA do first here? First, implement applicable laws and regulations related to federal taxes and relevant penalties, pay the authorities financial obligations, implement double taxation treaties ratified by both states because double taxation happens between two countries, avoid double taxation and combat tax evasion in cooperation with the concerned entities inside and outside the state. So basically, double taxation payments and implementation of law. Uh, Now decide the application submitted by the submitted for registration in the tax system. So naturally, FTA grants registration. It proposes legislation related to administrative collection and enforcement of the federal taxes. So lawmaking process also naturally FTA is involved, and relevant penalties and distribution of the revenues. Now that's a very key thing. The revenue that FTA collects, it distributes as well in coordination with the Ministry of Finance, collects statistical data and information related to federal taxes and relevant penalties. So data gathering is also a very, very important aspect which helps in policy formulation. Create records of registered taxpayers and keep these records as specified by the tax law. This is also something that FTA does. Issues directives and clarifications. You must have heard public clarification documents and other instructions for taxpayers with regard to the limits of their obligations related to the federal taxes and relevant penalties as well, in accordance with the mechanism decided by the board of the Federal Tax Authority. So you will find quite a lot of FTA decisions as well. Then coordinate with the federal government and the Emirates governments and taxpayers on all matters related to federal taxes, not emirate level taxes, federal taxes and relevant penalties. Contract with certain entities to execute certain works required by the authority to exercise its jurisdiction. So various projects might happen within the FTA, information related projects or other policy making projects. Exchange information and expertise with other states. So there is always tax information exchange between multiple countries and UAE that is also administered by Federal Tax Authority and international organizations, bodies, federations related to tax. Uh, OECD or United Nations related bodies and committees on taxes also, they deal with the Federal Tax Authority and naturally Ministry of Finance. FTA is a part of the Ministry of Finance. Coordinate and with competent authorities with regard to joining international tax organizations, bodies, and federations. It also represents the state, which is UAE, in regional and international conferences and meetings related to tax matters in coordination with the competent authorities in the state. in the UAE. Inspect taxpayers' records and documents. So naturally, this is like one of the procedural aspects. Review tax returns and reports submitted to the authority, audit them, decide on approving or amending the same, or request any additional information or documents. So all, from time to time gathering of information. That's also something FTA does. Issue certificates related to federal taxes. So tax residency certificates is a famous example of this. Finally, implement a mechanism to settle disputes between the taxpayer and the authority in accordance with the laws in force. Implement and set dispute settlement mechanisms like the arbitration, etc. Alternative dispute resolution. Demand access to any information or data available with any third party who may possess information on a person being subjected to tax audit, and that may be necessary for tax audit process as well. So, one of the taxpayers audit is being conducted. FTA may contact that person's vendors or customers or any other person for that matter. Demand from any person having dealings with a person subject to a tax audit to provide information, and that can happen. That interaction can happen with any person to get the necessary information while in the course of audit. Jurisdictions conferred upon the FTA under the Federal Decree Law number 13 of 2016. That's the law that constitutes FTA, formation of FTA, are compatible with the delegated powers contained in Article 62 of the tax law, basically. So, Article 62, if you read of the UAE Corporate Tax Decree Law, it identifies these powers that we have just learned to operate and manage UAE's corporate income tax system and procedures. Now, a key point of UAE corporate tax with regard to record keeping. That's article number 56. In this section, you are introduced to the bookkeeping requirements established by the Decree Law number 47 of 2022, which are as follows. Notwithstanding the provisions of the tax procedures law. So this tax procedures law was has been issued for quite some time now. It was updated from time to time. Last update of the decree law came in 2022, and then executive regulations also came in, which are effective from 1st March 2023. So, notwithstanding any provisions of the tax procedures law, taxable and exempt person shall maintain the records in different ways. So naturally, some exempt persons also have to maintain proof of their exemption. So taxable person, notwithstanding the provisions of the tax procedures law, a taxable person shall maintain all records and documents for a period of 7 years following the end of the tax period to which they relate, that support the information to be provided in a tax return or in any other document to be filed with the federal tax authority. Now, this 7-year rule is above than the statute of limitations, which is only for 5 years. So that's an exception. In case of tax records, 7 years is the maximum limit. And this the all the records that support the information to be provided in a tax return or in any document to be filed with the federal tax authority, that record has to be maintained. Enable the taxable person's taxable income to be readily ascertained by the federal tax authority. Those records should be such which can help FTA to calculate the income of the taxpayer. That was for taxable person. Regarding exempt person, notwithstanding any provisions of the tax procedures law, exempt person shall maintain all records that enable the federal tax enable the exempt person's status to be readily ascertained by the FTA for a period of 7 years. So nothing. For both it is 7 years. Following the end of the tax period to which they relate. In keeping all records for 7 years following on from the taxable year, The taxable person should have information available to respond to any FTA questions required for the FTA to accurately check the taxable person's declared taxable income. So that means that during the course of these 7 years, any time FTA can come back to the taxpayer and seek information related to these years. Uh,
Um,
yes,
Sorry, I just had a small question. So
yes.
earlier, like in the previous paragraph, we read that that they need to maintain books for 7 years, notwithstanding anything stated in Tax Procedures Law 2022. Why does it refer to that? Like, which requirement of the Tax Procedures Law would be like say different to the
So
7 years rule or
in
something?
in in certain cases there is a requirement for 15 years as well. So, certain exceptions have been provided in tax procedures law for real estate sector for other. So that's why
Okay,
they mentioned that if there is something provided in the tax procedures law, which from a prudence perspective, if it is even longer than 7 years, then it has to be complied. Okay.
okay, okay.
So, record keeping, Article 4 of the Tax Procedures Law number 2022. In this section, we share the bookkeeping requirements included in Tax Procedures Law number 28 of 2022. This is the mother law for tax procedures, basically. There is executive regulation as well. We will see. Any person conducting any business or having a tax obligation under the tax law shall keep accounting records and commercial books of his business and retain any tax related information as determined by the tax law according to the controls specified in the executive regulation. These provisions are incorporated in Cabinet Decision number 74 of 2023 on the executive regulation. So basically, for the mother law of tax procedures, which is law number 28 of 2022, the executive regulation came through a cabinet decision that was issued in 2023, which are called the executive regulations of the tax procedures law, contents of which are detailed in the following sections. Keeping accounting records, Article 2 of the Tax Procedures Executive Regulations of 2023. Accounting records and commercial books shall include, you will see that these are all common sense things that have been written there. Accounting books in relation to business, which includes records of payment, receipt, purchase, sales, revenue, expenses, etc. Balance sheet, profit and loss account, record of wages and salaries, fixed assets, inventory records, stock counts that are conducted, all documents supporting entries in accounting records and commercial books, including but not limited to correspondence, invoices, licenses, contracts related to the business, documents containing details of any election assessment, determination, or calculation made by the taxpayer in relation to the tax affairs of its business, including the basis or method of assessment, determination, and calculation. So all these correspondences, even with the customers, with the vendors, invoices, licenses, contracts, everything that helps ascertaining the tax calculations of the taxpayer must be maintained. These will be considered as records, commercial books and records. The books and records to be kept start with the business transactional information used in data entry and end with the annual financial statements. Naturally, that's where everything converges. That's why financial statements are very, very important. In addition to accounting records and commercial books mentioned in clause 1 of this article, FTA may require any other information in order to confirm through an audit trail the person's tax obligations. Period of record keeping, that was the question of Abbas. We'll see it in a bit more detail. Record keeping period. All accounting records, commercial books, and information shall be retained and maintained in a way that enables the FTA or any employee authorized by it to verify the tax obligations imposed on the person concerned for the following period, unless the tax law states otherwise. For a period of 5 years after the end of the tax period to which they relate in case of a taxable person, for a period of 5 years from the end of the calendar year in which the concerned document was created, In case of non-taxable person, which is exempt person, so to say, a period of 7 years from the end of the calendar year in which concerned document was created for real estate records. With the taxation procedures executive regulations, so 7 years has been mentioned for real estate. With the taxation procedures executive regulations requiring books and records to be kept for 5 years following the end of the relevant tax period, requiring them to be kept for 7 years following the end of the relevant tax period, companies should act conservatively. So, generally, in the tax procedures law, the period is 5 years after the tax period, and when we say tax period, in context of corporate tax law, tax period otherwise means any period that has been specified, but by default, it means the financial year that the company is following, which is a period of 12 months. Further period. In addition to the period specified in clause 1 above, the person shall retain the books and records for the following additional periods. In the following cases, we need to read this carefully. For an additional period of 4 years or until the dispute is finally settled, whichever is later, in case of dispute between the person and the authority in respect of the person's tax obligations. So, in case there is a dispute, additional 4 years apply. For an additional period of 4 years, in case the person is subject to an ongoing tax audit. So, for tax audits, another additional 4 years are required. For an additional period of 4 years, in case the authority notified the person of its intention to conduct a tax audit. Tax audit is not ongoing, but there is a notification issued by the Federal Tax Authority that we are going to audit. Then additional 4 years will apply in addition to the original 5 years, or in real estate's case, 7 years.
Yes,
Prior,
excuse me,
yes.
Altaf. I have a question. What about that 7 years? What is the difference between the 7 years and 5 years?
So
Who should keep the 7 years or 5 years?
yeah, so please understand that the default period will stay the same. Like for non-real estate, the default period stays 5 years. For real estate, the default period stays 7 years. These 4 years that we are reading, they'll be added to the default period, depending
Yes,
on the nature of business. If it is real
yes,
estate, it will mean 7 plus 4. For others, it will mean 5 plus 4.
yes. But Article 56, it says 7 years. It doesn't say the real estate or whoever. Yeah, I just say the 7 years for exempt person and the taxable person. And then this article says 5 years. Which one should be applicable for the taxpayer?
So that is why Article 56 says, if you read the Article 56, it says notwithstanding anything provided in the, let's read this. Yeah, this is the article that you're talking about. Am I right?
Oh, yes, yes, yes.
Yeah, Article 56. Let's read the wordings. Notwithstanding the provisions of the Tax Procedures Law of 2023, meaning without without disturbing, without affecting the provisions of the tax procedures law of 2023, an exempt person shall maintain the record for 7 years, and the taxable person again for 7 years. So if this you've raised a good point. Actually, this was a matter that was also discussed and addressed, and uh, by if we read Article 56, it says that it implies that the procedures law will actually specify. I mean, this is a general rule, but the procedure law will specify the exact period. That's what
Okay.
happened later on, right?
Oh, okay. Okay. That means 5 years.
Yeah. So by default, 5 years, but for real estate, 7 years. Okay.
Okay.
Period of record keeping, did we go through this? For the, yeah, we read this. Okay, for an addition, we read until this point. For an additional period of 4 years, in the case authority notified the person of the intention of tax audit. And then one more point we need to, for an additional period of 1 year, starting from the date of submission of a voluntary disclosure. So there is a provision in the corporate tax law as well as VAT law, that when you submit a voluntary disclosure, that okay, I omitted this, output VAT, for example, so I'm disclosing it now, or there was an error, and for that voluntary disclosure has been provided, has been adjusted. So if that is the case, then an 1 year duration is required to maintain those particular records.
1 year means a plus 5 years plus 1 year or the.
This is in isolation, right?
Okay.
This is an exceptional case where where there is a voluntary disclosure is made. 5 year, see, okay, let's read this. In addition to the period specified in clause 1 above, that means the default period of record keeping applies, but one more year will be applicable there. So 5 plus 1 or 7 plus 1 for
Oh.
for voluntary disclosures only. O- Okay. With the
Sorry,
F,
just
yes.
sorry, just on this point. So, we are saying five plus, let's say five plus four for a person who is not in who's not in real estate, right? But then, as per Article 56, it says notwithstanding tax procedures. So in that case, shouldn't it be seven plus four for all non-tax for all taxable persons who are not in real estate, rather than five plus four?
No, notwithstand, what is the, okay, let us discuss the meaning of these wordings, notwithstanding. In your view, what does that mean?
It
Let's
means
read
that
this.
it. So, as per my view, it means that regardless of what it says in the tax procedures law, it would be support for information be 7 years for a normal person, regardless if it's real estate or a normal taxable person.
Okay. So, actually, notwithstanding the provisions of the tax procedures law of 2023, uh, your interpretation is slightly different. What I understand is that in case there is a different period provided for in the procedures law, why the procedures law has been provided for this perspective. Abbas, if you really think about it, what is the difference between a decree law and a procedures law, or for that matter a cabinet decision, and later on the executive regulations that come to explain? The difference is that the decree law is the mother law. It's more like a constitution. It gives you a broad overview of what is this. So if they have mentioned that the general duration is 7 years, that means uh, on a broad level, on high level, the 7 years duration will be applicable. But when you go into details, then one, as a matter of fact, I'll tell you that even in the mother law of tax procedures, that is still a federal decree law, right? Even subsequently, as we read, there was a cabinet decision. So if I were a practitioner, uh, while my interpretation would be that the cabinet decision, which further explains the provision of the federal decree law at a granular level, that will take precedence. And more importantly, because the cabinet decision was the latest one that was issued in 2023, that takes precedence. But you are right in one angle that whenever even some ambiguity is available, we as practitioners must advise that this is an ambiguity. While our interpretation is different from the law, that we believe that the tax procedures law should prevail, should take precedence, because apparently the meaning of the word notwithstanding the provisions means regardless of the provisions of the tax procedures law. The challenge is that we should take a more prudent view or an adverse view. So from that angle,
Yeah.
yes. From that angle, as practitioners angle, yes, because it says that 7 years, so we will hold it for a longer duration of time. We'll advise the clients that better save yourselves, and rather than following the 5 year principle, follow the 7 year rule. But yes, this is the literal meaning of notwithstanding would be regardless. regardless of the provisions of the tax procedures law.
Yeah.
So yes, I do agree with you in that regard. I do agree with you that while my interpretation is that it should the minimum period should be 5 years plus the additional period. It would be prudent to maintain this 7 years, but we can further discuss it as well. We can look at
Okay.
it, but now whenever we advise to the clients, we always tell them that take the prudent view. And if there is an ambiguity between 5 years and 7 years, follow the 7 year rule.
Okay. Thank you.
So one more point, the voluntary disclosure 1 year we discussed. So default duration of time will apply, but for voluntary disclosures, 1 additional year will be needed to maintain the records. With the FTA allowed to require the taxable person to retain the books and records for a further 4 years when the taxable person is being audited or in dispute with the FTA, taxable person should be prepared to retain books and records for up to 11 years. So that's the understanding that they're repeating as well. That's what we just discussed, right? So default
Yes.
period, we are
Yes.
taking 7 years and plus additional 4 years. And in case there is a voluntary disclosure, you add that 1 year as well. Stand for up to
12
11
years.
years following the end of the tax period for which an audit or a dispute has been opened. Legal representative. Now, in the VAT law, usually this is mentioned as responsible person, but legal representative shall retain the books and records of the person he is representing for a period of 1 year from the date on which such legal representation expires. So, sometimes the tax agent will also be covered under this provision. So, if there were a tax agent and he stopped being the tax agent for a taxpayer, then the day he stops being the tax agent, going next 1 year he has to maintain data of the client.
What kind of data?
Sorry.
Data mean what kind of data? The same data your client is
So
maintaining or the lesser one?
the tax agent is not let us read this. Tax agent does not maintain the entire data, but legal representative is a broader terminology. So when we say legal representative, for example, in case of a tax group, you have to designate one company as the company responsible for the affairs of that tax group, if you recall. You can mute one of the, you have joined through two things. So can you please mute one
Okay. Okay.
because it is creating an echo.
Okay.
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 So yeah,
Legal representative mean it's not a tax agent, huh?
yeah. See, tax agent is a subset of it.
Okay.
Okay, superset means it can be, legal representative can be the person whose name is reflected as shareholder or even general manager. Those people whose representation is accepted by FTA, director, right? Those people whose names
Okay.
are mentioned in the trade license, and then naturally tax agent is also a legal representative. Why, of course, tax agent does not maintain entire books and everything, but tax agent does maintain all the necessary information that is needed to defend the returns, etc., file the returns. So obligation also falls on tax agents. From a practice perspective, I'm telling you something that the tax agents are required to take professional indemnity as well, because the liabilities of the companies which the tax agent is representing, if the company escapes, for example, without paying that tax obligation, tax agent is held responsible. That's why tax agents usually, those who do not pay attention to this point, or sometimes tax agents they don't require that kind of a collateral or guarantee from their clients. The seasoned ones, they know that this is a very critical responsibility and a dangerous one, because the taxpayer can run away without discharging obligations, and then the tax agent will be in hot waters.
Then it's very unfair, no? The tax agent is something outside. He's not He's not doing the business. He's not running the um, receiving the money and the things, but he has to pay the taxes.
Exactly. So that is why some tax agent may require a performance bond or guarantee of some sort from the client whom they are about to represent. So that is
Okay.
also that's something that happens. Methods
What
of keep
about for auditors? Auditors also the liability is like that. Auditors
the auditors
is
are
not
not
liable for that.
no auditors are not legal representative. This is an
Okay.
inside guy.
Okay.
Auditors are independent external people.
Okay. Okay.
They're
Okay.
not, yeah.
Auditors will not liable for any taxes or anything.
Auditors are liable for other things.
Yeah, other thing, opinion
They,
and the other things and all,
they are
they are
like,
giving wrong
yes,
opinion.
yeah,
Yes,
yeah, yeah.
it's,
They're
but
not,
other than that, the client affairs or tax payable or anything is
yeah,
auditors are
yeah.
not liable. No.
They are not responsible for the to discharge the tax liability of the companies, of course. Methods of keeping accounting record and commercial books. Article 4 of the Tax Procedures Executive Regulation 2023. Let us go through the obligations of maintaining records and books. Uh, this will be met through any of the following two actions: creating the record and retention of the original documents which support the entries contained in the records. So, original entry documents, basically, source documents. Creating the record and preserving the information that was contained in the original document, provided that the information matches the data contained in the original document and shall be available during the periods referred to in Article 4 of this decision. The information is retained or stored in a manner that enables FTA to verify the person's tax obligations. So, if you really think about it, this is indirectly referring to digital record maintenance as well. The obligation to keep books and records is fulfilled if the taxable person creates the records and maintains and preserves the original documents, and is so doing. In so doing, ensures the records match the originals. The information may be stored either as a photocopy or in other easily readable formats. To be quite realistic, now the world is moving paperless. It has already moved towards a paperless environment, but still, I mean, quite a few companies maintain paper documents. Company A retains its records in electronic form using a recognizable document retention software platform will be compliant. So that is why document management systems have gained a lot of importance. FTA may lay down the rules preserving the information contained in accounting records and commercial books and impose such reasonable requirements for ensuring that the information will be readily available to it as if the original records themselves had been preserved. At the date of writing, no such rules have been published. But from practical perspective, I'm telling you that if you are able to provide digital copies, that suffices FTA. FTA does not create a lot of fuss on the paper document. If it is an original document, it is verifiable, then they accept it. Persons records with the tax agent. Article 15 of the Tax Procedures Law 2022. Persons records with the tax agent. Mr. Nozer, your question will be
Yes.
answered now. In this section, requirements of a person to share record with the tax agent are contained in the Tax Procedures Law number 28 of 2022. This is the mother law of tax procedures, law number 28 of 2022. Tax agent must keep the information, documents, records and data related to any person that is or was represented by the tax agent for the period and manner specified in the executive regulations of 2023. Tax agent shall, upon FTA's request, provide it with all the information, document, records, and data in his possession in respect of the person that is or was represented by the tax agent. FTA requires the tax agent to keep information. Let's see the example. X company taxation consultants LLC should be compliant were it to retain all working papers created when preparing Y company's tax returns for the tax period 31st December 2024 until 31 December 2031. How many years
Yes,
are we
7 years.
looking at? 7 years.
7 years.
7 years. So
Uh, the working papers mean he's only
Yes.
he's working, not the supporting
Yeah.
document of
Yes.
the
So
client.
naturally, I mean, when a tax agent will be preparing a tax return, they will ask for the underlying documents to the extent that they can prove or defend the taxpayer in front of federal tax authority, right? So it's a judgment call. I mean, they can't say that, provide us with all of your general transaction level detail of general ledger. In today's world, actually, they can do that because it is easier. Why? Because digital data dump is available. So tax agent can say that, please provide us with all the data dump as well. They can do that. But the key point is that if they have sufficient information where they can defend, and it is a judgment thing, you can't, it's very difficult to put a hard and fast rule as to what information would suffice. Otherwise, the entire information is a very unlimited thing.
Yes, correct, correct. You can't keep invoices, bank statement, those things for 7 years. You know they you handling many clients. You know, 1,000 clients, and then how then the record keeping will be a issue there. No.
Yeah, but again, on a practical note, depends which size of the of the tax agent are we talking about. Usually, tax agents would, even if I mean, on the average, if a tax agent has 100 clients, that I would say that's a hell of a successful tax agent here in
Yes.
UAE. And considering the digital data maintenance. Now, it should not be a big deal for them to maintain it if it is digital. But hard copies, yes, that will be a nightmare.
But Australia also, I'm also tax agent. The documentation, record keeping, everything is client's responsibility.
Right, right,
It's
right.
not agent. They will not ask from agent. They will ask from client only, because client's document, they have to keep it.
Yeah. So I think the answer would be quite easily given from the audit profession also. So because independent external auditor also expresses an opinion. So usually what the information that they obtain, it's quite similar to that. So they're not responsible for maintaining books, auditors, right? But they take
Yes.
information. Same thing. So language, Article 5 of the Tax Procedures Law. So we are going to look at the Arabic and English language related matters. Let's have a look at it. Uh, First rule, every person shall submit the tax return and any data information records and documents related to tax that he is required to submit or otherwise requested to submit to the FTA in Arabic. The default language is Arabic. However, in reality, we do all the work in English actually. That the ground reality. Notwithstanding Article 5, Clause 1 of the Tax Procedures Decree Law, FTA may accept the tax return, data, information, records, and documents related to a tax in any other language, provided the person provides the FTA with a translated copy of any of these in Arabic if requested by the FTA. So, as specified in the tax procedures executive regulation. So, if you read the wordings of it, may. So, FTA has kept kind of a pressure on the taxpayers, but as I said earlier, the ground reality is that, I mean, unless there is a major dispute or something, it doesn't happen. Everything is happening in UAE in English because of the, huge amount of expats living here and working here. The person who submits any translated copies of data, information, records, and other documents related to any tax to the FTA shall be responsible for the accuracy and correctness of such translated copies and shall bear all the associated costs. FTA shall be entitled to rely on the translation provided. So, the tax return and data, information, record, and documents are to be supplied to FT in Arabic. So this is a summary of what we've just read, but may be accepted in any other language, provided that Arabic translation is provided. where the information returned to be supplied to FTA in a language other than the Arabic language, then the person providing the return and data is to provide the is responsible for the accuracy of the translation. I'm just going to the use of a language other than the Arabic. Article 5 of the Tax Procedures Executive Regulation 2017. So this is an earlier version of it, which was probably not changed. In the section, you will review the position taken in the Tax Procedures Executive Regulation on the language. FTA may accept data information records and other documents related to any tax to be submitted in English, and the FTA may, at its discretion, require the person to translate some or all of that to Arabic. Translation of any tax return, data, information records and documents or other books into Arabic must be approved in accordance with the law regulating translation in the state and submitted to the FTA within the period it specifies. So same points repeated. The only difference is here the one of the key languages, probably the most dominant language in UAE, English, has been specifically mentioned. FTA requires Y Company LLC to supply transfer pricing data and other information covering its 2024 tax period. Y Company LLC will be compliant if it forwards that information to the FTA in English, providing the same information is available to be forwarded in Arabic should the FTA require the material in Arabic. That's only a conditional statement. If the FTA says that provide us in Arabic, only then you will be required to provide in Arabic. But does that actually happen in reality? I haven't. Usually, I haven't seen that happening. English correspondence FTA usually accepts. Financial statements. This is Article 54 of the Corporate Tax Decree Law. FTA may, by notice or through a decision issued by the FTA, request a taxable person to submit the financial statements used to determine the taxable income for a tax period in the form and manner within the timelines prescribed by the FTA. Unless the FTA requires the financial statements for the tax period to be supplied to it, there is no requirement to do that. Let us read the last one. Unless the FTA requires the financial statements for the tax period to be supplied to it, there is no requirement to do so. So a financial statement should be provided only if requested. The minister may issue a decision requiring categories of taxable person to always prepare and maintain audited or certified financial statements. So there's a ministerial decision number 82 of 2023 on the determination of categories of taxable person required to prepare and maintain audited financial statements for the purpose of tax law. So the let us have a look at it. Decision prescribes that following categories of taxable person shall prepare and maintain audited financial statements. So a taxable person deriving revenue exceeding 50 million UAE dirhams. So Mr. Nauzar, you plan to already open an audit practice here in UAE. You should know that the minimum revenue requirements is 50 million dirham for audited financial statements. That's when it becomes mandatory. Below 50 million, we advise clients to maintain financial statements only, not necessarily audited. However, it helps the client always to take certification or audit on those financial statements also, but it is not mandatory. Another angle we should remember is that under the qualifying free zone person regime, it doesn't matter what your revenue is, you have to maintain audited financial statements. So just a quick quiz question. How many tax regimes are there in the UAE? Can somebody answer this question? Article 3.
Two.
2. Abbas, do
Three.
you agree? Yes.
Three.
3. Actually, there are three regimes. By now, we should remember there are three regimes. Momin, what are those three regimes?
Federal tax authorization, FTA, the federal level tax, and the emirate level tax, and the free zone level tax.
Okay. Can Momin give this answer? Anybody else wants to, other than Abbas, can anyone else give this answer? Farjat? Farjad, are you there? Can you hear me? Okay, since nobody is giving the right, Ramsha, can you give the answer? Anybody who knows the answer to this other than Abbas? Because the answer provided by Mr. Nozer may not be accurate. Okay, no one is giving the answer, so I'll request Abbas to give the answer.
So there's the normal tax, then there's a qualifying free zone person, and the third is a minimum top-up tax.
Yes, three regimes that are there, Mr. Nozer. First one is the default regime or normal tax regime, where
FTA,
we don't
let's
call
say
it
federal tax.
we don't call it FTA regime, sir. FTA
Okay.
regime, we don't call it. We call it normal or default usually. Okay,
Okay.
every regime is FTA regime from that angle. Okay, so because this is the normal regime means first 375,000 dirhams worth of
Okay.
taxable income is zero rated. Above that 9%. That's the normal regime. Okay.
Okay.
Uh, Second regime is qualifying free zone person regime. So the
Yes.
person is earning qualifying income, so zero taxation on qualifying income
Mhm.
and flat 9% taxation on non-qualifying income.
Okay.
Flat. There is no
Yes. Okay.
375K zero rating threshold in qualifying free zone.
Okay.
Second regime. Third one, the name given in Federal Decree Law number 60 of 2023 is the top-up tax regime. That this top-up tax regime was issued later on in the original decree law. That this third regime is not mentioned in Article 3 for your information. If you open the tax decree law and try to find this, you will not be able to find it in the decree law. The tax decree law of 47, number
See,
47 of 22.
it's
This
it's it's not within our syllabus. It's not. It's not.
No, no, no. It's not. We're not, really going through a syllabus as such because this is a practitioner's session. So we are. So anything and everything is in our syllabus if you really think about it, because we are learning what or discussing what we are discussing from a battlefield perspective. We will be actually facing clients and we'll be saving them and making sure that they are compliant. So anything that comes in is within our scope. Okay, so and from that perspective, I'm telling you, this we discussed earlier as well in our previous, I think, when we were going through the transfer pricing module, there also we read this. Top-up tax regime was a federal decree law issued in 2023. That law number was law number 60. Okay, decree law number 60. In that, the law said that we are changing the Article 3 of the original tax decree law. Okay, Mr. Nozer?
Yes.
So the article number 3 is that article which provides these regimes. Okay, so the new decree law said that we are adding one more clause to article 3, and that clause says that a third regime called top-up tax regime will be introduced. And what does that regime do? It looks at multinational enterprises under BEPS Pillar 2. If it is a multinational enterprise under BEPS Pillar 2, meaning if it earns 750 million euros of revenue per annum, and it is present in multiple countries, then the UAE part of portion of that company, the taxable income will be taxed at 15%. Okay, and the difference between the normal regime and that 15%, that is called the top-up tax. So that tax will also be paid by the taxpayer. So we should remember these three regimes by now. For the purpose of Article 54, 1 of the FTA may request a partner. This is a key point. Okay, I'm going to ask this question if someone can answer this or remembers it. For the purpose of Article 54, FTA may request a partner in an unincorporated partnership to provide the financial statements which show all of the following: total assets, liabilities, income, expenditure of the unincorporated partnership. Total assets, liabilities, income, expense. This is because these shares are to be recorded in the partner's own return. The partner's distributive share in the unincorporated partnership's assets, liabilities, income, expenses. This is because these shares are to be recorded in the partner's own return. So, what is an unincorporated partnership? Can anyone answer this?
Is it like unlimited partnership? Something like the all partners are liable for the jointly and severally
They're liable,
liable for the
right? So, what was the default tax treatment of an unincorporated partnership? Abbas, don't answer. Anybody else?
individual partners should file the returns.
Correct.
It's not
So,
the partnership companies.
correct. So, the income is taxable in the hands of the partners. That was
Yes.
the default treatment. What was the
Yes.
exceptional treatment, exceptional option provided to unincorporated partnerships?
They could request the FTA to be treated as a whole, not as individual partners.
So
As a company.
they could go to FTA and say that, don't tax us at partners level, but treat this unincorporated partnership as an entity, as single fiscal unit, as one taxpayer, right? That was the exception. So but in either case, the point is that as per Article 54, FTA can request a partner to provide financial statements of the unincorporated partnership itself. Okay, because their distributive shares will be determined on the basis of the entity level financial statements. Okay. While the FTA may require a taxpayer to file its financial statements, and it may also require categories of taxable persons to have their financial accounts audited, this requirement to audit does not counter the requirement to audit financial statements set out in commercial companies law. So these requirements of audit that we read, they were from corporate tax law perspective, not from commercial companies law perspective. This 50 million dirham requirement that we read, that this is the minimum threshold where audited financial statements are mandatory, this is from corporate tax law perspective. From a corporate law perspective or from a free zone law perspective, different treatments may apply. Uh, depending on the free zone or mainland, there are different treatments that are required. In relation to unincorporated partnerships, we read this, so let us not repeat. Now we are coming to transitional rules, which is Article 61. Mr. Nozer, since
Yes.
you'll be starting this practice, hopefully, so you need to understand the transitional rule very well. It is important. Uh,
About opening balances, huh?
Yes, opening balance. Decree
Yes,
Law
yes,
number 47 of 2022 contains transitional rules applying to the financial statements for the tax period ending immediately before the tax period in which the person becomes a taxable person. These are relevant because the closing balances become the opening balances, which must be compliant with the corporate tax law. A taxable person's opening balance sheet for corporate tax purposes shall be the closing balance sheet prepared for the financial reporting purposes under the accounting standards applied in the UAE on the last day of the financial year that ends immediately before their first tax period commences, subject to any conditions or adjustments that may be prescribed by the Ministry of Finance. So there is a ministerial decision 120 of 2023 on the adjustments under the transitional rules for the purposes of federal decree law number 47. So this ministerial decision 120 is a detailed one and it identifies what adjustments are required for transition. The opening balance sheet referred to in Article 61 of the decree law shall be prepared taking into consideration arm's length principle in accordance with the Article 34 of the tax decree law number 47. Let me ask you a question. Uh, the company that was already present in existed in 2023, their first tax period is starting from 1 January 2024. Okay. So, what will they need to do for their 2023 financial statements? Looking at what you have just read, what is the first thing that, key considerations that come to your mind for the 2023 financial statements? Anybody can answer this?
They need to like redo the balances as at June, end of the end of June,
Why June? We're talking about tax
December,
year of
December.
December. So why June?
No, no, December, because the
December.
tax year starting from the June.
January. No, sir.
No,
The
no, no.
default.
I know Dubai, UAE. That tax is starting from the June of 2023. No,
Yeah. So
that is the first year. That is the 6 months for the company. Then company is 1 year.
yeah. So companies existed in 2023,
Yes, 23.
and I am telling in an example that the first tax year that was applicable to the company was 2024. I'm giving you this
Ah,
information.
ah, ah,
Now,
24 December. You mean
yes,
24 December, and then the opening balances will be the December 23.
December 23. Correct.
Yes,
So
and they
when
need to amend. They need to adjust the closing balances of 23 in
Mhm.
order to comply with the tax law.
What is that one most important principle that they need to ensure in 2023
Arm's
financial
length.
statement?
Arm's
Arms length.
length.
Correct.
Yes.
And what could be the implication if they, for example, let's say accounts receivable that are appearing in 2023 balance sheet, okay, which is the pre-tax period. We need to remember that 2000 these financial statements that the company is finalizing, 2023 financial statement, 31st December 2023 financial statement. These are closing financial statements that will
Okay.
become the opening balances during the tax period, right? So let's say accounts receivable that are appearing in the financial statements, they were, let's say, overstated. What would be the tax implication of that? Corporate tax implication.
They pay more taxes
How? Well, this is
because
an
the
opening. This is an opening balance sheet,
yes, but
and it
opening
is
opening
accounts receivable.
yes,
What is?
opening will be receivable in the next year. No,
Yeah. So what is the corporate tax implication?
it depends like which basis the corporate tax accrual basis or cash basis.
So by default, IFRS is there, and
Accrual basis.
yeah, very very rare circumstances cash basis.
Okay.
99.9% companies follow accrual basis, IFRS
Okay.
compliant. So anybody can think, Kalima, can you answer this question like account receivable? Let's take the example of account receivable. What could happen? What could go wrong and could have a corporate tax implication because of account receivable during 2024, which is a tax period? Anyone? Otherwise, I'll have to ask Abbas and he will give the answer. Okay, nobody's giving the answer. Abbas, what do you think? Why do the accounts receivable need to be on arm's length and what could be the corporate tax implication during 24?
Um, I guess one thing could be if it's overstated. By overstated, do you mean that it is non-recoverable, irrecoverable? I mean, if that's the case, then you could probably be claiming. I mean, if it's
You're right,
you could
actually.
be
Just think
claiming
about it.
less.
Huh.
You could be probably claiming less provision expense in the tax return. That's maybe one thing.
Yeah, so we could use better wordings, but you hit the spot. Actually, you're right. What could happen is the corporate tax implication could be that if we had overstated the receivables in the opening balance sheet, Mr. Nozer.
Yes.
And what will happen if we book a provision for expected credit loss in 2024? So what would it hit our profit for the year, taxable profit for the year? Am I right?
Yes.
Right. So what if there is excessive provision booked in 2024? The profit will go down.
Yes. Yes.
And why our profit of 2024 went down? Because of an overstatement in the opening balance sheet.
Yes.
Overstatement of accounts receivable in our opening balance sheet. So we had to book a larger than necessary provision. So this is one example. There could be other examples as well.
Fixed assets, the overstating the fixed asset value, also depreciation will
Yeah,
increase the.
or for that matter, impairment. You rightly said. Impairment can result in even bigger impact. Depreciation is a normal, usually 1 year impact, straight line impact. Impairment, on the
Impairment
other
of.
hand, could be a huge impact, right? So that is with the corporate tax, income tax, while the corporate income tax commences for accounting periods on or from 1 June 2023. In reality, it commences in the previous year, even though tax is not paid for the previous year. This follows from the fact that the opening balances in the first tax period are the closing balances in the previous period. So that is why we say that 2023 financial statements are very, very important, even though it may be pre-tax period, pre-tax financial statement. Since Article 61 requires the opening balances, let's read the examples directly.
Excuse me, Altaf, I have a small question. This, the tax law, corporate law start from June 2023.
Mhm.
If a company is preparing a financial end of December 2023, how
Mhm.
they will adjust the this is for 7 months in a year. The tax law started in June means 7 months, and then the other 5 months, then they need to adjust in between, or how they do.
So first of all, we need to understand the applicability of corporate tax law on the
Yes.
incomes of companies or taxpayers or
Yes.
potential taxpayers. How it applies is first accounting period after the uh, 1st June 2023,
Okay.
falling due
Okay.
after the 1st June, which is the starting date of the corporate tax law. So,
Accounting period. Right. Okay. Now understand.
from this perspective, uh, the entire 2024 will be the first tax period.
23, end of 23 will be the whole period will be the
No,
first year.
no. 23 will be out of scope.
Okay. Okay.
2024 will be the first tax period. Why? Because the corporate
Okay.
tax law came into effect from 1 June 2023. So we need to look at the next accounting period, the very
Ah,
first accounting period falling next after 1 June 2023, which will start from 1st of January, right?
yes. First
Right?
of January to December. Okay.
1st January to December, provided that the company follows the calendar year as
Okay.
its financial year.
Okay.
So, this could be a situation that, some corporate tax consultant may say that, let's adjust your financial year and let's, take it before 1 June 2023. So let's say, for example, 30th May. It will be an effort to kind of, avoid the tax, or maybe immediately after first June. Let's say first of July is your. Let's start your tax year from the 1st of July. If what will happen, Mr. Nozar, if the financial year of the company starts from 1 July? We remember that the tax era, corporate tax era, started from 1 June. So what
Okay.
will happen to those companies whose financial year starts at 1 July 2000? So which will be their first tax period?
Will be 2023. No.
Yes, 1 July 2023 will become their first
Okay.
tax period, right? So
Yes.
I mean, it will go against their benefit, right? 6 months of
Yeah, correct, correct,
unnecessary
correct.
corporate
Yes,
taxation
yes, 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 yes,
they will need to
yes,
give. But
yes,
what
yes.
if their, but what if their tax, their financial year started from 1 May, 1st of May? Then what will be the situation?
And then they can escape 1 year.
Almost, 11 months they can escape.
Uh, escape, yes,
11
escape,
months.
escape,
So,
yes.
what will a half-cooked tax advisor tell to the client without knowing too much? He'll say, well, why don't you start your tax period from 1 May, right? But the practical and ground realities we need to understand. First of all, this financial year is usually mentioned in the memorandum of association. You cannot arbitrarily start any year, right?
Yeah, correct,
So
correct.
that means if you want to change your tax year, then you have to change the memorandum of association, first of all,
Okay, yes,
right?
yes.
Secondly, uh, don't you think that FTA knows what we are talking about right now?
Yes, yes, yes,
Right?
FT,
So
they know
that's
everything.
where another article, which is called General Anti-Abuse Rules, that triggers. Meaning, when the taxpayer on purpose does make some changes remaining within the law only to avoid tax, that's where the GAR triggers, General Anti-Abuse Rule, and FTA may disregard this action. Okay. So, anyways, Y Company LLC's financial statement for the year ending 31 December 2023 contains service fee income derived from a related company established in Qatar. So there is service fee income related to a company in Qatar, and we are considering the year ended or ending 31 December 2023. Fees for the services were charged under a 5-year service agreement entered on 1 Jan 22. When Y Company LLC's auditors reviewed the company's financial statement for the 22 statements, they detected that the service fee had been calculated at cost without a profit margin. Mr. Nozer, what is the implication?
Yes, the service cost is without
Profit margin.
yes, yes,
Do you think
without
this is arm's
profit.
length?
No, no, it's not arm's length.
This is not arm's length. So
Yeah.
this is something, if the service fee basis is not adjusted for the 23 accounting period, the opening balance of 24 accounting period will not be impacted for an accrual taxpayer. We need to understand another angle. Uh, the effect will be favorable for government treasury or adverse. This also needs to be looked at. So if we are talking about revenue, Y Company is a taxpayer in UAE, right? And it is a revenue in their books, their service fee income. So they are
Yes.
understating the income from a
Yeah.
transfer pricing perspective. So if you are understating the income, then the corresponding accrual or receivable will also be understated. So that these things. This is how Y Company LLC purchased. Now we're talking about purchased a ceramic tile cutting machine from its Qatar related company on 30th June 2022 for 10 million dirham. When the fair market value of the machine was 7.5 million dirham only. Y Company LLC does not impair the cost in its books at 31st December 2023. So, a very good example. The, the fair market value was less, but the cost that was recorded was higher, right? So, it should have been adjusted in 23 financial statement. Y Company LLC 1 January 24 opening balance is opening written down balance on that machine will be in breach of the corporate tax law because the annual depreciation should be based on the arm's length amount and not the related party consideration. As a matter of fact, one could argue that the entire value should be brought down.
Sorry, just a small question. It's
Yes.
actually linked more to our previous session rather than this one, but um, so a company when they're preparing their statutory financial statements, for any related party transactions over there also they have to make sure that effectively those transactions are following one of the two methods for transfer person which we discussed in our previous class,
Right.
even for statutory reporting, right?
So,
Not just for tax reporting then.
y- you know, there there is a good possibility that IFRS may condone a treatment, and uh, uh, while IFRS are accepted, uh, the FTA can accept IFRS treatment. Why? Because if you really look at IFRS, for example, the biggest angle in this regard, especially for the assets recognition, would be the testing of impairment, right?
Yeah,
Uh,
yeah.
I mean, we are actually experiencing this on certain clients, and if you look at the impairment testing, Abbas, under IS 36, can you recall what was the rule that they apply there?
It's you compare the carrying amount to the higher of the fair value less cost to sell and the value in use.
Exactly. So, while fair value less cost to sell, which is the net selling price, that's an easier, the calculation is simpler. Obtaining of information may be difficult. But what about the value in use? Value in use is the future cash flows, correct?
Yeah.
So
Yes.
in either case, the point is that what we are doing at the closing date, cutoff date, is we are estimating the fair market value. If you really look at it, the fair value, it can be the present value of future cash flows or the net selling price. Either ways, it will give the fair value or fair market value of that particular asset, which will be compared with the carrying amount, right? So that is the whole point of impairment testing. So by default, if you follow the IFRS, you are becoming compliant with the fair value principle, arm's length principle, isn't it?
But then value in use wouldn't really give me the fair value, the fair market value, because that's basically telling me that that how much benefit can I get from the use of it of the asset rather than selling it. So
Correct.
that would necessarily be the fair market value, right?
Yeah. So let us create a distinction, a very fine line of difference between the words fair market value and fair value.
Okay.
Can
Yeah.
we?
Okay. Yeah. Yeah.
Okay,
Yeah.
do
Okay.
you get my
Okay.
point?
Yes.
What I'm trying to
Yes.
say here?
Yes. Yes.
So,
Yes.
the net selling price is actually fair market value. Why? Because we are talking about a
Yes.
consideration that a knowledgeable willing buyer will pay, right? Whereas the future cash flow, the discounted present value of the future cash flows might give a fair value, which is the benefit that is going to accrue to the enterprise, which is the central concept of an asset that is explained in the framework to the international financial reporting standards or accounting standards, right? So in either case, we are getting the recoverable amount of
Yeah.
that asset, right? So
Yes.
that means if a company is compliant with the IS 36 in estimating the recoverable amounts or the carrying amounts, then it is already considering the fair value or fair market value of the asset. So that
Yeah.
is why FTA bases its a lot of focus and dependence on IFRS. I
Okay.
hope I was able to answer your question.
Yeah. Okay.
Okay.
But then if let's say it's a normal like a service income, that kind of contract. So in that case, like you would still need to make sure because my point is that the financial statements would need to either comply with one of the methods given under the tax law for any such transactions, or you'd have to make separate financial statements for tax and statutory accounting purposes.
Okay. So let us break down your question. First of all, let me tell you that there are very rare circumstances when corporate tax law may diverge from the treatment of IFRS. Very rare circumstances are there. One example is other comprehensive income, where reclassification of the gains, which will never be reclassified to the income statement. Those gains, that's one divergence that is there. But why I mentioned this is because in case, God forbid, there is a divergence between IFRS and corporate tax law, then the corporate tax law will prevail to begin with.
Yeah.
Okay, okay. That I think we both know. What was your question again?
So if let's say the there's a service income,
Uh,
so in that case, that service income would need to follow the principles for transfer pricing as laid down in the corporate tax law, where we discussed those two methods in our previous
right.
session.
Now, before I forget, let me answer this question. Very good. Clear, clear. So you were saying that the service income, for example, the
Yeah.
company was booking internally and they were reflecting it in their financial statement at cost, and they were not complying with the arm's length
Yeah.
principle. They were saying, "This is our company. We want
Yeah.
to book it at our, discretion." And that is why we are booking the income at cost. We don't want to give a markup to it, right?
Yeah.
So from an
Okay.
internal management perspective, or even from an IFRS perspective, this may be allowed. This
Yes.
this may be allowed. But when we are preparing the corporate tax return, that's where the adjustment will trigger in. And those adjustments, the entire track or trail of those adjustments from starting from this particular tax period will need to be maintained until,
Yes.
so you are right in that sense that it can happen that even auditors may condone it, saying that they, because auditors are not thinking only from the corporate tax law perspective, they're looking
Yeah.
at it from
Okay.
IFRS perspective.
Yeah.
Their entire ambit is IFRS. So from an IFRS perspective, if this treatment is acceptable to them, because this is a management decision and it is a business decision that we don't want to charge markup by on the service cost fee. So auditor will not have any objection on this. They'll say, okay, fine, go ahead. I mean, you're not violating IFRS principles, so we will give a clean opinion. So they will not raise any questions on that. But when it will come under the magnifying glass of corporate tax law, that's where, while filing corporate tax return or preparing the calculations, the tax advisor will advise, they will say that, look, hey, while IFRS allows this treatment, not charging markup on the service fee, that is fine from IFRS perspective, but from corporate tax law perspective, you have to book the adjustment, transfer pricing adjustment, right? So that will be done. And one more thing, yes. For now, I am going to talk about even IFRS perspective, Abbas. Very interesting angle that will come.
Yeah.
Because in the course of audit, because of this particular scenario where there was no markup charge, right? That revenue was okayed by the auditors, right? Given an okay.
Yeah.
But what about the provision for corporate tax? That's where the
Yeah.
auditor will object.
Yeah. Okay.
Provision, while
Okay.
calculating provision for corporate tax, that's where the auditor will say, now I am sorry, now I have to resort to corporate tax law. So if you're
Okay.
creating a provision disregarding that profit, that was a transfer pricing adjustment, I'm not going to give a green signal. So there you have to take the effect.
Okay.
Agree with
Yes.
me? Oh,
Yes. Agreed. Agreed.
okay.
And so just one another point because it just came to mind based on this one. So if let's say in the audited financial statement submitted for tax, there was an error which was not picked up by the auditor as well. So in that case, could the tax authorities also penalize the auditors for that? Tax authorities, not the corporate tax regulatory body.
Okay, so that's a very interesting question. What you're saying is, forget about the taxpayer. Will the tax audit,
Yeah.
will the independent external auditor be penalized?
Yeah.
Right? Yeah. So,
Yes.
honestly speaking, until now that I have gone through, there may be only one thing that the Federal Tax Authority may do for such a situation. If it was a glaring mistake, a blunder kind of a mistake, and it was a very major taxpayer, there may be a blacklisting that could happen. That is the only thing that would happen, because auditors are not registered with the Federal
Yeah.
Tax Authority, right? So
Okay.
it's not their scope to take an action on the auditor. The maximum they could do is that they could blacklist it and instruct all the internal stakeholders of Federal Tax Authority who look at the tax returns to pay attention to any audit reports that have been signed by this particular auditor, because he is in our blacklist. So so we
Okay.
have to look at, that's the only thing that they could do.
Okay.
Okay.
Thank you.
Tax registration, Article 51. Registering for corporate tax. Any taxable person shall register for corporate tax with the Federal Tax Authority in the form and manner and within the timeline prescribed by the Federal Tax Authority, and obtain a tax registration number, a unique number issued by the Federal Tax Authority to each person who is registered for corporate tax purposes in the UAE, except in circumstances prescribed by the minister. Long story short, there is something called TRN, tax registration number, and it is a unique number that is given to each taxpayer. FTA shall issue that. The FTA opened early registration for corporate tax in January. So that's history. Exemption from corporate tax. For the purpose of an exemption from corporate tax under the Decree Law number 47 of 2022, or for the purposes of Article 53 of the Decree Law, FTA may require the relevant person under Article 4 of the Tax Decree Law or the unincorporated partnership as applicable to register for the corporate tax and obtain a tax registration number. So key words for us to see or read or remember are FTA may require. So there can be a situation where FTA is of the discretion that this particular taxpayer should register. So they have this power to instruct that entity or business or taxpayer to actually obtain a TRN. A relevant person under Article 4 of the Decree Law 47. What is Article 4? Can anyone other than Abbas, anyone else can give this answer? What is Article 4 of the Decree Law? What does it address? Come on, guys. Kalima? Farjad, are you there or you're on mute? Yeah, I think quite a few people are here, but they are not really here. So I don't know. Ramsha, are you there? Okay, very good.
Yes.
So do you know what is Article 4 of the Decree Law? What topic does it discuss? So Mr. Nauzer, are you aware? This is an article that addresses exemption, specific exemption of certain types of persons. Okay, so please remember the importance of Article 4. This is the mother article of exemption. So which specific types of businesses are exempt under corporate tax law? Okay. A relevant person under Article 4 of the Decree Law could be one of the following. Now, it's a repetition of the article, so it's a good thing that it's saving your time. Qualifying public benefit entity, that is one type of a specifically exempted person. A qualifying investment fund under Article 10 of this Decree Law, an investment fund, a public pension or social security fund, or a private pension or social security fund that is subject to regulatory oversight by the competent authority. So, public or private pension funds or social security funds, which are properly regulated under the law, they will also enjoy the exemption. A juridical person incorporated in the state that is wholly owned and controlled by the above ABF, some of these above, entirely wholly owned and controlled subsidiaries, they will also be considered as exempt persons. But those subsidiaries must undertake part or whole of the activity of the exempt person. They are engaged exclusively in holding assets or investing funds for the benefit of the exempt person, or they carry out activities that are ancillary to those carried out by the exempt person. Uh, a f- you know, Four categories are also exempt person. They have not been mentioned here. Can somebody recall those very important four categories? They are, uh, let's hear from someone. Miss Kalma, are you there?
Um, Government entity, government controlled entity.
Hmm. Very good. Two categories you identified. Two more categories are there.
Then I think the extractive a person engaged in extractive business.
Okay, and very good. Three answers correct.
Um,
What is the fourth one?
and
Non-extractive natural
non-extractive natural resource business.
business. So the extractive business ordinarily would be oil and gas business, right? Non-extractive natural resource business will be, for example, refineries, etc., distilleries, refineries, etc. Okay. Any other person as may be determined. So these are the specifically exempted persons. So please pay attention to what I say, because quite a few people join and then they mute themselves entirely during the course. So it is not a good idea. But please understand that why this Article 4 is very, very important is that as I repeated number of times earlier, the way corporate tax decree law is organized logically is that whenever we start to look at taxability of a person, first thing that we look at is by any chance, is this an exempt person, specifically exempt person? That is how we start off. So if it is a specifically exempt person, then the entire course of assessment changes. So these are the examples of the exempt persons. Once they are none of these, then the original assessment action starts. So we start looking at legal structures, this, that. Ministerial decision number 43 of 2023 concerning exceptions from tax registration for the purposes of decree law. Uh, it identifies which are what exceptions are there from tax registration for exempt person. FTA shall, at its discretion and based on the information available to the FTA, have the ability to register a person for corporate tax effective from the date the person became a taxable person. So, FTA will identify that your exemption or taxability starts from this date. Registration is to be made in the form and manner approved by the Federal Tax Authority, even if the entity to be registered qualifies for an exemption of tax in specified circumstances or in yet to be defined circumstances. Right? So, simply put, entities who are claiming exemption must also claim it in the form and manner prescribed. One example: the A Derivatives Fund, a DIFC established and qualifying investment fund managed by Z Manager LLC, an ADGM regulated manager, chooses not to register for corporate income tax because the FTA has confirmed its exempt status. FTA on 30th November 2023 confirms all qualifying investment funds must register for corporate tax and obtain a tax registration number. So, A derivative funds does not receive the information of the requirement to register and fails to register on time. A derivative fund will be in breach. So, that's something for us to remember. Qualifying investment fund is actually an exempt category. It's an exempt person. But you cannot assume that if I am from a category of exempt person that I do not have to register even. You have to refer to that exceptions related decision number 43 of 2023, which contains the exceptions of who has to register and who does not have to register. So now we're at tax registration, deregistration, and amendment of registration data. Article 6 of the Tax Procedures Law 2022. In this section, we consider the registration, deregistration, and amendment of data provisions included in Tax Procedures Law number 28 of 2022. So first thing, taxable person must apply for the registration with the Federal Tax Authority in accordance with the provisions of the law. So manner is a procedural level manner information is provided on the website of FTA as well, and the tax procedures law as well. Registrant must include his tax registration number in all correspondence and transactions with FTA and others in accordance with the provisions of the tax law. Inform, so TRN must be referred while speaking to Federal Tax Authority while corresponding with FTA. Inform the FTA in the form and manner prescribed by FTA of the occurrence of any event that might require the amendment of information related to his tax record kept by the FTA within 20 business days. This is a key information, guys. So any change in circumstances, you've inducted a new shareholder, for example, or you change the name of the company. So trade license and memorandum has changed, right? So that information must be provided within 20 business days from the occurrence of the event. Apply for deregistration in accordance with the relevant conditions in the tax law. This is also a compulsion. Mr. Nauzer, just for your information, what will happen if a company that was required to deregister did not deregister?
Uh,
Simple answer, penalties.
yes, yes, penalties. Yes, yes.
Penalties will apply. Executive regulation. The executive regulation outlined below will specify the procedures for tax registration, deregistration, and amendment of registration data. So there is an executive regulation issued in 23. Government bodies. Government bodies concerned with licensing a person to conduct a business are to notify the FTA within a maximum of 20 business days of the issuance of any license in accordance with the provisions of the executive regulation. So you should recall, I mean, other than Mr. Nauzer who joined at a later stage, quite a few of you uh, remember that, in the earlier lectures where we talked about exempt categories, where we discussed government entities and government controlled entities, we saw one exception in the exempt rule of government entities, that sometimes government entities may do business by obtaining a trade license. Kalima, you recall this?
Yes.
Government entities
Yes, government
sometimes,
entities that are issued from, they have a license issued by the licensing authority.
yes, so they will be that part
Yes.
of their business will be subject to tax, right? So,
Yes.
so if that happens, they have to notify FTA within 20 business days. It is unlikely to be simple for a license holder to avoid registration, since the license issuing regulator is required to notify the FTA, Federal Tax Authority, of the issuance of the license within 20 business days from the issuance of the license. So that is a very key point. Those companies who are getting new registrations, they should know that even without informing them, FTA is becoming aware of new companies being formed. Okay, so tax deregistration, Article 52. Uh, Very interesting angle. Let me ask you a very simple question. Uh, Only, a natural person, which is usually referred as the sole establishment, right? Which has the equivalence status of a natural person in the UAE corporate tax decree law. Other than that, mostly every entity is required to register. LLCs, free zone entities, etc., etc., registered partnerships, they are all required to register with the Federal Tax Authority, even if they're not making any income. Even if they've only registered, they are required to register with the Federal Tax Authority for the purposes of corporate tax law. So, what could happen that they might be required to deregister? Can somebody tell me? When would the deregistration for the corporate tax happen? If this question were for VAT, the answer would be easy, that the company has fallen below the VAT threshold of 375,000 dirhams, or even the voluntary threshold of 187,500 dirhams, then the company must deregister for the purposes of VAT. That was the VAT answer. What about corporate tax law? When would a company be required to deregister, in your view?
The company stop trading.
Yes, company not stop trading. I would not say that. Company has decided to liquidate. The liquidation has started.
Okay, liquidation.
So there is a difference, right, Mr. Rosa? Stop
Yes,
trading
yes,
and
yes.
liquidation. Stop
Liquidation.
trading means company is not liquidating. It has become dormant, right? But
Okay.
liquidation means company is about to go off the register of the companies. person that a tax registrar shall file a tax deregistration, a procedure under which a person is deregistered for corporate tax purposes, application with the FTA, where there is a cessation of its business or business activity, whether by dissolution, liquidation, or otherwise. So this is the key thing: dissolution, liquidation, or otherwise, in the form and manner and within the timeline prescribed by the FTA. So,
Here it's
uh,
Just 1 second. Here it's mentioned cessation of a business activity, as in
yes,
like maybe the
cessation.
business continues,
No, 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 hold on,
just
hold on,
the
hold on, hold on. I knew that you are going to ask this question. It's a good question asked, by the way. Uh, while it is written cessation of business or business activity, but it not must not be read in isolation. It must be read in conjunction with this sentence. Kalima, you understand what I'm saying? Where
yes.
there is a cessation of business or business activity, whether by dissolution, liquidation, or otherwise. That is the key thing. Cessation of business and business activity can happen without dissolution, liquidation as well. Correct? A company can become dormant. So many companies are being used in UAE only for visa purposes. You know that, right? People just come to UAE and open a company so that they can obtain a visa sometimes, right? But do you think those companies are required to register for corporate tax? They're not doing any business. They sometimes don't even open a bank account. Are those companies required to register for corporate tax?
They have to
They have
register.
to. They have to register in the form and manner. Did I answer your question, Kalma?
Yes, you did.
Okay.
Is there any automatic system that where the commercial register will send the information to the FTA?
This
When
is,
the
yes, this is happening. FTA, whenever the mainland Dubai economy or DED, Department of Economic Development of the Ministry of Economy, or for that matter, free zones, they are required to provide this information to FTA. Any new company gets registered, information will reach FTA, but FTA cleverly will stay silent. They
why
will
they are staying silent?
they will allow no, the violation, because it is not, because the law is already there, and FTA remaining silent is within the law. They cannot act as mother of the companies and you know start calling them and say that, hey, you have just gotten registered, please register with us. They have issued the law. Minister of Finance has issued the law. The decree has been issued by the president. Cabinet decisions have been issued. Law is already there. It is for the taxpayer to become aware of the law. Ignorance of law is not an excuse. This is $1 million quote of the legal world, right?
Yes, yes, yes. Yeah, Australia, what happened? When you open a company, then the company registrar will send the information to the authority. They will open a tax file also for him and send the information to him. This is your this is your
Yeah,
tax file number. You start paying tax.
right. No, things will gradually improve in this region. So, still I would say UAE and Saudi Arabia are quite ahead of the rest of the GCC in
Yes,
that.
yes,
So,
yes. I can see the UAE advanced than the Qatar.
it is.
Qatar tax law is very simple and very small in content, but the UAE one is yes.
Very detailed. Tax Authority decision number 6 of 2023 prescribes a set timeline for natural persons and for juridical persons. So you can find those things in the corporate tax guides as well. It is a very good idea to visit the Tax Authority website and look at the legislation and corporate tax guides. Natural person shall file a tax deregistration application within 3 months of the date of cessation of the business or business activity. Now, for natural persons, uh, the tax deregistration is secondary, but the first stage will be registration, right? So let me ask you this question: when does a natural person become, required to register for corporate tax? Can somebody give me this answer?
A
When
partner
you
in
start a
an
business,
unincorporated partnership.
and trade
Unincorporated
license.
partnership, uh, uh, they okay, but that's if you really think about it, Abbas, unincorporated partnership is again a natural person, right?
No, no,
Because the
no.
default,
I meant
uh,
sorry. I meant the partner in that partnership.
correct, he is required to register, but at what stage? There is a
When
threshold
the
to be met.
business exceeds 1 million.
Exactly, 1 million. So natural
Okay.
persons are required to register for corporate tax when their annual revenue exceeds 1 million dirhams. If their annual revenue does not reach this threshold, they are not even required to register for corporate tax. That is why I was intrigued to ask this question. Tax
Okay.
deregistration in their case, because they are natural persons, they will be required to register, and in their case deregistration can happen on cessation of business as well, because there might not be any liquidation involved, right? But cessation of business will be applicable to natural person. That's where Kalma's point becomes valid. Kalma, you that's what your point was, right? Cessation of business.
Yes.
So only in case
Salka,
of, yeah.
in one case, suppose a company actually they didn't register on time and they already have a penalty. And then they recognize that they are going to liquidate the company. So when they are going to deregister now, will this penalty still stay or what will be the condition?
So you know first of all, we should remember from a practical perspective, when does the penalty information come, Kalma? That's the key point.
Okay.
So the when see, for example, we have dealt with these cases that one company did not get registered for corporate tax perspective, and they reached out to consultants. So people like us, they would tell them that, look, you have not registered for corporate tax, but your deadline has already passed, so you are already in violation, right?
Yes.
But they will not receive a notification from FTA. Why? Because they have not even registered. The day that they register, and they know that the violation has already happened, they have breached the deadline. The very next day, they are going to receive an email from FTA saying that you registered later than the deadline. The penalty of 10,000 dirhams is applicable to you. So, and then, they will need to pay the penalty. They will not be able to escape. But those taxpayers who have not registered, they have breached the deadline, and they are aware that if they register, they will very next day they are going to receive the email saying that you have been penalized with 10,000 dirham. And as a strategy, they're thinking that let us not register at all, liquidate the company. So it remains to be seen yet whether, if they deregister the company, whether they will still be approached by FTA saying that your company was operating within the tax period and you were supposed to register and you did not, and that is why you have a penalty. Actually, there will be even one more penalty applicable to them, that it was a requirement for you to register. Failure to register, and then the another penalty will be for delay in registration. One is failure to register, one is delay in registration. These are two different offenses. So it remains to be seen whether such companies will be approached by FTA. To date, I don't have that information. We have not been we have not seen anything as yet. But there is a chance that those companies, because this is still the early years of this, they may escape it, but who knows? We will get to know. Actually, I will do this investigation. I will find it out whether such companies who have gotten, who liquidated after knowing that they were penalized, whether were they actually approached by FT or not. This is still not clear.
Okay, thank you.
So the juridical person shall file a tax deregistration application within 3 months of the date the entity ceases to exist. Juridical person shall file the tax deregistration application within 3 months of the date the entity ceases to exist. This is applicable to companies especially. Cessation of the business, dissolution, liquidation, or otherwise. Uh, uh, this cessation of business we can look into in greater detail, but the idea is that the the this company will cease to exist. Chances are that they will cease to exist. Conditions of deregistration. A taxable person shall not be deregistered unless it has paid all corporate tax and administrative penalties due. Now that's a very that's a very risky affair, especially for people like Mr. Nauzer who are starting off. Please understand that in case there are penalties or something and the company tries to quickly deregister, they will not even be allowed to deregister unless they have paid and cleared the dues.
Yes, clear the news also.
uh, and filed all tax returns due under, and if they delay in that, every passing day it could increase to the penalties, including its tax return for the tax period up to and including the date of cessation. Date of deregistration. If the tax deregistration application is approved, FTA shall deregister the person for corporate tax purposes with effect from the date of cessation or from such other date as may be determined by Federal Tax Authority. So that's a notification actually. Once your deregistration process completes, you have filed the final tax return, paid all obligations to FTA, whether tax due or penalties. Once that is cleared, then in a notification, FTA will inform the effective date of deregistration of the company, of the taxpayer. Non-compliance. Where a person does not comply with the tax deregistration requirements under Article 52, FTA may, at its discretion and based on information available to the FTA, deregister the taxable person effective from later of either the last day of the tax period in which it became apparent to the FTA that the conditions in Article 52, which is article on deregistration, have been met, last day of the year, or the date the taxable person ceases to exist. So the FTA may deregister. Now, one should ask that it goes to the it goes in the interest of FTA to keep the person registered for tax purposes, right? Why would FTA deregister by its own action? That's a question someone should ask, right? What could be the logic behind it? Can somebody tell me? Because if the person is still a registrant, FTA can impose additional penalties for not filing tax returns or etc. etc. So why would FTA deregister someone out of its own action for corporate tax? Can
Because he
someone?
can
Yeah.
create, he can collect some taxes and other thing and make
So
some
how
manipulation.
how will FTA collect taxes like if they
Not
are
FT.
deregistering a company?
No, business can collect some the VAT and the other things.
No, but that's not, we're not reading VAT, we are reading corporate tax, right? So, yeah, Abbas, do you have a view?
Maybe if the company ceases to, if it's like a foreign company and they like cease to exist, I mean, they cease to have business in the country
Yeah,
and they
correct.
don't do it voluntarily. I mean,
Or think of it this way, company simply does not exist any longer. So,
yeah.
FTA becomes aware the company is already it has been given a liquidation certificate by the free zone or mainland, right? So what is FTA even considering then? Who is it going to collect taxes from, right? So it would reduce administrative burden, and FTA will be in an odd position if they continue the registration for a company that does not even exist, right? So that is why
So
FTA might deregister by their own action. that it
So
will look.
basically, we can say that. Sorry. So basically, we can say that wherever the company does not voluntarily deregister, the FTA would register them.
FTA would deregister it because they will know that, okay, we
Yeah.
can't do much about it. The company has already gotten their liquidation certificate and it is no longer existing. So it's a funny situation if we say that this company's tax registration number is still active or like that. So FTA will deregister by their own action. Registration and deregistration for tax purposes. Article 6 of Tax Procedures Executive Regulation. Uh, uh, In the section, you will learn more about tax registration and deregistration. Let us look at the topics here. A tax registration application shall be submitted to the Federal Tax Authority in the form and manner approved by it. And FTA may specify any supporting documents to be submitted for that purpose, naturally. FTA shall review the tax registration application in accordance with the rules. So, form and manner we discussed, and then the review can happen from FTA side. Tax registration shall be finalized by issuing a tax registration number for the applicant or by reactivating a previous tax registration number. So TRN, the FTA will issue a TRN to the taxpayer or reactivate the previous one. A registrant shall notify the Federal Tax Authority in the form and manner approved within 20 business days of any changes to the data, trade license name, etc., legal type, entity type, so nature of business within 20 days. So key point here. Tax deregistration application shall be submitted to the FTA in the form and manner approved by it, and FTA may specify any supporting documents to be submitted for the purposes. So information basically, FTA may ask information. FTA shall review the tax deregistration application in accordance with the rules approved by it in this regard. So review of application for to register. In case where registrant does not submit a deregistration application, FTA may deregister such registrant in accordance with the control and procedures stated in the tax law. Uh, you know, Again, this is the last point we had discussed, all the discussion of why would FTA deregister someone on its own action. Tax deregistration shall be finalized by suspending the tax registration number. So, the TRN will be there, but it will be suspended. The authority shall notify the person of its tax registration, deregistration, or reactivation based on the mechanism adopted by FTA in this regard. Now we're coming to tax periods and tax returns, Article 57 and 58. You will learn them. So let us look at it. A tax person's tax period is the financial year or part thereof for which a tax return is required to be filed. So financial year. Tax period for the purpose of corporate tax law means the financial year. For the purposes of the law, financial year of a taxable person shall be the Gregorian calendar year. Key point, Mr. Nozer, because you're new to this law. Gregorian calendar year is the default tax period or the 12-month period for which the taxable person prepares financial statement. It can be different as well, but you will be able to see this in the memorandum of association.
That means starting from January
Yes,
2024.
Jan to December. Yes. The tax period is the financial year, which is the Gregorian calendar year 31 December to an or an alternative 12 month for which the taxable person has prepared financial statements. Okay, let's quickly read the example as well. Y Company LLC completes the financial statement for the 12 month ended 31st December each year, providing Y Company LLC does not change that accounting period. The first tax period shall commence 1 January 2024. And another example, Z Business Company completes its financial statement for the 12 month ended 30th June each year, providing business company LLC does not change the accounting period. The first tax period shall commence on 1 July 2023. Interestingly, we discussed this example on our own. This means that the transitional rule will apply to the balances as of 30th June 2023. Change of tax period. Article 58. Notwithstanding Article 57 of the decree law, a taxable person can make an application to the FTA to change the start and end date of its tax period or use a different tax period subject to conditions to be set by the FTA. So there is a decision. FTA decision number 5 of 23 issued 7 April 23 lists down the conditions for change in tax period for the purposes of Federal Decree Law number 47. So if you want to know how can the tax period be changed, you have to read the FTA decision. So at this stage, just to recall your memory, I'm going to ask the various levels of law making here in the UAE. So, Mr. Nazar, do you know what the law making process for the corporate tax? How many different tiers of law making are there? Top tier is which one?
No, I don't know, sir.
Okay. Anyone else would like to answer this? Kalima?
Constitution.
The top of the
Top
list
tier.
is constitution, naturally. So which is, constitution is even above the president. So it is all the heads of the emirates, rulers of all the 7 emirates of UAE came together and signed or approved the constitution. That's how UAE was created. That's the top level of lawmaking. Okay, constitution was created and a president was appointed under the constitution. What is the next level of lawmaking under corporate tax law?
Federal decree law.
Very good, very good. So the very next level, the top level after constitution is the federal decree laws that are signed by whom? Kalima?
The president.
The president. Okay. After federal decree law, what is the next stage?
Cabinet minister's decision.
Cabinet of ministers. So are we talking about the Ministry of Finance only or
No,
others as well?
the other ministers altogether.
So there is a cabinet in UAE of federal ministers. All the ministers that are there in that cabinet, Minister of Finance, Foreign Affairs, Economy, etc., Defense, all of those ministers are present in that cabinet, right? So when they give a decision, that's known as the cabinet decision. Okay, what next? What is the next level of lawmaking?
Ministerial decision.
And what do we mean by ministerial decision, Kalma? Can you please elaborate?
The Ministry of Finance.
Exactly. So under the corporate tax law, after cabinet has given a decision, they may leave certain areas saying that, okay, this can be given, we don't need to speak about it because this is too technical and it should be sorted at ministry level. So finance ministry level. So that's where the Minister of Finance issues decisions. They are known as the ministerial decisions. Okay. Then, Kalima, sometimes the minister may also leave certain aspects saying that this is too operational for even for the ministry level. So, who is going to do the next level of lawmaking?
FDA.
Federal Tax Authority. Why? Because Federal Tax Authority is a part of the Ministry of Finance, and those decisions are known as
Authority decision.
Federal Tax Authority decisions. So, is there anything below this? Usually this is the last year, but there can be public clarifications also that are issued by the Federal Tax Authority. Public consultation documents might be there. Stuff like that can also be there. Then corporate tax guides are also there. Sometimes even at guide level also you find interpretations given by FTA which might not be visible in the FTA decisions or ministerial decisions or cabinet decisions. So this is what it is. Mr. Nazar, did you understand?
Yes, it's like a 4 levels, no?
Yeah, four
Up,
levels.
up
Yes.
to ministry.
President, cabinet, ministry, FTA. Four levels. Yes. Okay. Tax returns, Article 53. In this section, you will let's talk about tax returns. Subject to Article 51 of the decree law, taxable person must file a tax return as applicable to the federal tax authority in the form and manner prescribed by the FTA no later than 9 months from the end of the relevant tax period. No later than 9 months, okay, or by such other date as described by the federal tax authority. So that means the returns of 2024. What is the deadline, Mr. Nozer?
The September, end of September 2025.
25. With a tax return to be filed with FTA no later than 9 months from the end of the tax period, and if the normal tax period ending on 31st December, it is 30th September. Example, okay, let's not, it's a very easy example, so I'm going to skip it. Tax return must include the following information. So what are the components of the tax return? Tax period to which the return relates, name, address of the TRN, date of submission, accounting basis, taxable income, amount of tax loss relief claimed under Article 37 of the decree law, tax loss relief. There are certain provisions related to tax laws, okay, Mr. Nozer, that
Yes.
you can claim the previous loss that you brought forward during this year, but pre-tax losses cannot be claimed. Okay.
Okay. Okay.
Amount of tax loss transferred under Article 38. So you can transfer within qualifying groups where 75% common shareholding is there. One company can transfer tax loss to the other company. The available tax credits claimed. So there can be foreign tax credit, there can be, simple tax credit itself as well. So UAE does not have withholding taxes, so the domestic tax credit will not be there. But there is one possibility of a domestic tax credit as well, in case you have paid excessive tax or because by a mistake you have paid extra tax. That can be a tax credit.
What
Corporate
about the
tax,
credit on the dividends received?
say again.
The tax, credit on the dividend received from the company?
Dividend
Another company?
received by the company.
Yes, yes.
If dividend is an exempt income, if it is received from a domestic company of UAE, and
Mm.
UAE does not have any withholding tax, the rate of withhold, wrong statement actually. It is wrong
Okay.
to say UAE does not have any withholding tax. The right statement is UAE does have withholding tax provision, but the rate is 0%. So
Okay.
UAE has 0% withholding tax rate. So there is no deduction on the dividends from a domestic
Local companies. Okay.
company.
Okay. Okay. What about
But
overseas?
what about the companies in, for example, Saudi Arabia, where there is deduction of tax on dividends? So in that case, the question will be whether that dividend is taxable or exempt. Mr. Nazar, do you understand this
Exempt.
point?
Exempt. Yes.
So if it is an exempt dividend, then you cannot claim tax credit for that.
Okay. If it is like not exempt, then you can claim. No.
Then you can claim, because then your dividend income will be taxable. In
Mm.
rare circumstances, dividend income will be taxable if it does not meet the participation exemption
Yes.
criteria,
Yes. Yes.
etc.
5% holding and other things. Huh?
Whatever amount of holding is there on the dividend, if it because that dividend on which tax has been withheld will not be from UAE. It will always be out of UAE. In
Okay.
UAE, there is no deduction of tax on dividends.
Okay.
So,
Okay.
so it will always be from out of UAE. And if it is a dividend that is received from out of UAE, then multiple aspects will come into play here. Double tax agreement will come into play between the two countries. We'll have to see that as well. And the tax credit, according to the foreign tax credit rules, shall be claimed.
What about the withholding tax from the payment UAE company make to Qatar or something? And then the withholding tax has to be paid
I,
like
I think
any.
you want to say it the other way around. The payments that the foreign company makes to UAE companies, because
Okay.
UAE company making payments will not deduct tax,
Okay.
right? So and UAE actually this scenario that you just mentioned relates to foreign customers. export customers or other customers out of UAE. So when they pay and in their country there is a withholding tax
Yes.
law, that's when the UAE company can claim a tax credit, which is called the foreign tax credit.
How come UAE is giving the credit for the tax paid in another country? Say in Qatar, we are paying to the Qatar tax authority. Then for that payment, how come UAE FTA is giving the credit? They didn't receive the money.
Right. So there is something called international or cross-border taxation in which uh, two countries agree on the withholding of taxes. So, that amount of taxes which were deducted on payments being made to
UAE.
UAE sellers, okay, that was a that was a geographical sourced income for that country. That
Okay.
country had a taxing right around it. That
Okay.
taxing right has been addressed and discussed in detail in the Model Tax Convention 2017 of the OECD. So those countries later on became members of the inclusive framework of the OECD, and they agreed that okay, we will some taxing right we will retain, other tax other some the relief right will be available with the company who is facing this withholding tax. So by accepting the credit, think about it this way, Mr. Nozer. UAE company sold something to Qatari company, and there was a tax deducted by the Qatari buyer, okay, and they
Mm.
paid the tax to the Qatar tax authority. That's
Okay.
so they were right to deduct it because that
Yes.
income was geographically sourced in Qatar, right?
Yes.
The buyer was sitting in Qatar, so did they have
Mm.
the right to do that? It is justified, right?
Yes. Yes.
It is
Yes.
justified, right? Okay. Now that money came to the seller in UAE. UAE is about to tax that income, right? But
Okay.
because that's a taxable income, correct?
Yes. Correct. Correct.
That income will be included in the corporate tax return of this seller in UAE or not? It will be, right?
Yes.
Why will it be included? Why should it not be excluded? Because that's a foreign sourced income. So that's where double taxation comes in. You remember the two doctrines of taxation: residence based taxation versus source based taxation. So the residence based taxation is a show of power. Why? Because those companies which are registered in any country, the revenue authority of that country says, since you have registered in our country as business, your entire worldwide income will be taxable in this country.
Mm.
This is residence based taxation,
Yes. Yes.
right? So don't you think that this Qatari sourced income is being taxed two times? If it is taxed already in Qatar and now it is being included in UAE corporate tax return also, and again tax is applied on it.
Yes. Correct. Correct.
Do you think
Yes.
this is
Yes.
fair?
No. No. It's not fair.
It's not fair. That's why double taxation agreement exists. But
Mm.
it's not a one-sided thing. It is a two-sided thing. In the double tax agreement between Qatar and UAE, this matter would have been addressed and discussed in detail between the revenue authorities of the two countries, and they know that UAE does not have withholding tax, but Qatar does. So naturally, the tax authority of UAE must have negotiated with the Qatar tax authority, and then they came to a conclusion, and that conclusion was reflected in the double tax agreement. So whatever the provision of that agreement, that will prevail in terms of tax credit. If that agreement says that this company, the UAE company, seller company, can claim that tax credit in their corporate tax return, then they will enjoy. But
Okay.
but one more thing you should remember, that double tax agreement supersedes the UAE corporate tax law.
Okay. Okay.
Why does it supersede? because that double tax agreement was signed under Vienna Convention. And the
Okay.
Vienna Convention says that if there is a disagreement between bilateral treaty of those countries who have agreed to the Vienna Convention and their domestic laws, then the bilateral treaty will prevail. Vienna Convention says that.
Okay.
That is why this double tax agreement takes precedence over the domestic law of UAE. Okay.
Okay. And then the UAE company says that the UAE Dubai companies gross payment is 1,000 riyal, and they deduct the 5%. Then they
No,
pay.
Dubai company does not deduct, sir.
No,
Qatari
no, no,
company.
no, no, no. I'm telling Qatar company. I'm sorry. Qatar
Huh.
company deduct like 5%, and they pay like 950 to the UAE company.
Okay.
Okay, and then how much is the income for the UAE company? Like 950 or 1,000?
You tell me actually this.
Yes, yes,
That's a very good
yes,
point, but this is an accounting question. You think
yes,
about it. The
yes.
original,
They
what will
will
be the
make.
original entry? What will be the original entry?
Yes,
Well,
they will make it 1,000,
1000.
and yes,
Correct.
and deduct the 50 as a tax paid or withholding tax paid, a deduction for tax.
Correct. So now give me the answer, please. There are two entries. First is the revenue recognition entry, account receivable debit, revenue credit 1000, 1000.
Yes,
That's the revenue recognition entry, correct?
yes, yes,
The credit side, 1000 dirham in the revenue, that will go to your profit and loss account, right?
yes, yes,
So that's your answer. The taxable income will include 1000. The
yes,
second stage, second leg of this transaction, which is the collection leg, does not
yes,
even touch your profit and loss account. Why? Because
yes,
it is account receivable being credited 1000
yes,
dirhams and one foreign tax asset being created with 50 dirhams and cash coming in, cash debit 950 dirhams. So that does
yes,
not even touch your profit and loss account. The PNL
yes,
impact will be 1000 dirhams.
yes, correct, correct. And the and the 50 will be deducted from the tax payable to the
Yes,
FTA.
that's called the foreign tax credit.
Okay,
Yes.
okay, okay.
Rules of tax returns.
Yes,
Uh, Let us see the rules. As an exception to the provisions of Article 53 and any other relevant provision of the decree law, the minister may prescribe the form and manner in which the tax return and other information is to be filed with the FTA by a taxable person, where the disclosure of information may impede national security or may be contrary to the public interest. So that's form and tax return and other information to be filed by the FTA by a taxable person. And so this is form and manner of filing the return and also disclosure of information. So information exchange related laws are already there, and treaties are there that they will be considered. FTA may request a person under Article 4. Article 4 is what? Exemption, specific exemption uh, of the decree law to submit a declaration. Key point. An exempt person may be required to submit a declaration that of exemption. All the categories of exempt taxpayers under Article 4.1, such as qualifying public benefit entity, which have been approved as being tax exempt by the FTA, may still be required to file a tax declaration. The reason for requiring a filing would be for the FTA to determine whether the entity continues to comply with the exemption requirements. So, if as I recall, this tax declaration is not applicable to government entities, government controlled entities, and extractive and non extractive natural resource business. FTA may, by notice or through a decision issued by the FTA, request the authorized partner in an unincorporated partnership that has not had an application approved under Article 16 of the decree law to be treated as a taxable person to file a declaration on behalf of all the partners in the unincorporated partnership. So, for unincorporated partnership, FTA may require a tax declaration uh, to be filed or for the exemption. There may be circumstances where you know because this is each partner will register himself as an exempt person. So FTA may ask the unincorporated partnership to just file a declaration and be over with this. The parent company must file a tax return to the FTA on behalf of the tax group. Very, very important point. So there is always a parent company in a tax group in the UAE corporate tax law, which holds 95% of the shares or other controlling interest. They are the responsible persons. They need to file the tax return. All taxable persons are required to file a return, and all non-government owned exempt entities may be required to file a tax return or tax declaration. Tax return preparation and submission, Article 8 of the Procedures Law. So let us read the preparation. Every taxable person shall prepare and submit the tax return to FT in accordance with the provisions of Tax Procedures Law. So every taxable person settle in any payable tax within the time frame specified in the Tax Procedures Law and the Decree Law of 2022. Uh, Incomplete tax return. Any incomplete tax return submitted to FTA shall be considered as not accepted by FTA if it does not include the minimum information required as specified in the Decree Law number 47 of 2022. So, it it may be subject to penalties as well if we file an incomplete tax return. Every taxable person is responsible for the accuracy of the information and data in the tax return and any correspondence with the FTA. So all accuracy and correctness of data is the responsibility of the taxpayer. Settlement of tax and penalty. Every taxpayer shall settle any payable tax and administrative penalties within the time period specified. Determination of payable tax. Article 9 of the Tax Procedures Law. Taxable person shall, when paying any amount to the FTA, specify the type of tax and the relevant tax period to which the amount relates, and FTA shall allocate the amount paid accordingly. So, tax period has to be identified as to how much amount of tax relates to which period. When a taxable person makes any payment without specifying the type of tax or the tax period, FTA shall have the right to allocate the full amount or part thereof for settlement of tax or amounts due as specified in the executive regulations. So if you don't clarify how much amount of tax is being paid for what purpose, FTA will allocate it. So it has to be clearly communicated. If the taxable person pays an amount greater than the value of the payable tax or has a credit with the FTA, FTA may allocate the amount or credit to settle any tax or amounts due as specified in the executive regulation. So those of you who have filed VAT returns before, whenever your refund balance is there, becomes a tax rate, next quarterly return you're filing, that amount of tax credit is already deducted and net liability comes in, which is a reduced amount. If the taxable person pays an amount less than the value of the payable tax, the provisions of Chapter 4 of Title 3 of the Tax Procedures Law will apply. So there are penalties, tax assessment and administrative penalties assessment and collection of tax. So those provisions will apply. There are penalties specified for underpayment of tax. Without specifying the year for which the tax is being paid, FTA is able to allocate the tax as it chooses fit. Assume ex legal consultants prime tax liability for the tax period 31 December 2025 amounts to 85 million, and assume it owes the FTA 1 million for the accounting period ended 31st December 2024. If ex legal consultant does not nominate 85 million as being the 2025 tax liability, the FTA has the right to apply 1 million to first pay for the 24 debt, leaving the company uh, short paying the 2025 tax by AED 1 million. So, in our correspondence, we have to clarify that this liability that we are paying off, this relates to which tax period. Allocation of payments and credits. Okay. So, if the taxable person settles any amount to the FTA without specifying the type of tax or tax period to which it relates, FTA may allocate the amount for settling any debts or liability due to FTA based on seniority. The oldest, the first in first out, FIFO method. The oldest liability settled first. Excess. If the amount received by FTA exceeds the taxable person's existing liabilities, FTA shall treat the excess amount received as a credit against future liabilities of the taxpayer, where the taxable person did not request the excess amount to be refunded. You can request, but it is advisable not to request it.
Excuse me, I have a small question. Will
Yes,
they
please.
charge any interest for the delayed payment?
Yes, it has been identified. In certain cases, you have to refer to the tax procedures law. In certain cases, even interest may be applicable.
Interest plus the penalty, yeah?
Yeah, penalty and then on top of it, interest. Yes.
Okay.
The original amount and then the interest and even penalty may attract interest.
Any percentage interest
No,
they have
that's
fixed? The
it is not practical for me to answer this actually because there are too many penalty clauses there. So it's not one rule that you have to go there. There is a schedule.
Okay.
So quite a few things have been mentioned there in the tax
Okay.
procedures law. Okay. FTA may allocate the credit balance or part thereof to settle any amounts due to the authority by the taxable person according to the seniority of such amounts due to FTA. So naturally the same rule, FIFO, first in, first out. Notify. FTA shall notify the taxable person regarding the allocation of payments and credit according to clause 1 and 3 of this article. So notification will always be there. FTA has works under a framework whereby they need to notify. Now, calculation and settlement of corporate tax, which is Article 44. In this section, you will examine the rules in Decree Law number 47 of 2022 covering the how tax is calculated and settled. The corporate tax due under the law is settled in the following order. Let's see. First, by issuing the taxable person's available withholding tax credit as determined under Article 46 of the decree law. So, first, what was the first thing? Available, how much of withholding tax credit is available? That's one. To the extent there is a residual amount after Article 44(1) by using the taxable person's available foreign tax credit. First, we are looking at the hierarchy. First is the withholding tax credit. After that, FTA will look at the foreign tax credit under the Article 47. That was your Qatari withholding tax that you were mentioning. To the extent there is a residual amount left after Article 44(2) by using any credits or other forms of relief as specified in a decision suggested by the minister. At the time of writing, no decision has been published. To the extent there is still a residual amount after Article 44(3), this amount of corporate tax must be settled in accordance with Article 48 of the decree law. So, the following statement prescribes the decree law number 47 provisions how corporate tax is to be paid. A taxable person must settle the corporate tax payable under the decree law within 9 months from the end of the relevant tax period or by such other date as determined by the Federal Tax Authority. At the date of writing, no such publication has been made. One example is there. Assume X legal consultants prime tax liability for the tax period 31 December 2025 amounts to 5 million and assume it has paid in advance 82 million corporate income tax. Assume it has a 475,000 withholding tax credit as well relating to fees received from a client in India on which the tax had been deducted. The net UAE corporate income tax payable will be 82,525. Why? Because This was the total, 5 million was the total liability. Out of that, 2 million already it was paid in advance. So that leaves only 3 million dirhams. From 3 million, another 475,000 has been deducted, which leaves only 2.525 million. That this amount must be paid to FTA by 30th September 2026, because this pertained to the tax year 2025. Last date for the filing its tax returns for the 31st December 2025 accounting period. FTA shall issue the taxable person a notice of the FTA's decision on an application under Article 49 in accordance with the tax procedures law. Now we are coming to the refund, which is Article 49. For FTA, it is quite a sensitive matter. A taxable person may make an application to the FTA for a corporate tax refund in accordance with the provisions of the procedures law in following two circumstances. Number one, withholding tax credit available to taxable person exceeds the taxable person's corporate tax payable. So you can claim a refund. Or where the FTA is otherwise satisfied that the taxable person has paid corporate tax in excess of the taxable person's corporate tax payable. That's where the error that I was mentioning has come in. Because of a mistake, we paid extra. Put a zero extra maybe. A taxable person may apply to the FTA for a tax refund after having paid all taxes due if there remains an excess of the amounts paid over the due amounts. Let's look at the example. For example, assume ex legal consultant's corporate tax liability for 25 is 350,000 dirhams. And assume the withholding tax credit is 475,000 dirhams. So there was more withholding tax available, more withholding tax asset available than the corporate tax liability. Then the FTA is to refund the extra 125,000 to ex consultants, even though the excess had been paid to a tax authority of a foreign jurisdiction rather than to the UAE Federal Tax Authority. So, although this was a foreign tax credit, the FTA will refund it. So, there is tax refund procedure, Article 26 of the Tax Procedures Regulation. So, let us have a look at this. Subject to further conditions specified in the tax law, a taxpayer may apply for a refund as per the mechanism specified by the FTA. At the date of writing, no such mechanism has been identified yet. So FTA shall, within 20 business days of an application being submitted, review the application and notify the taxpayer of accepting or rejecting the refund claim. How much is the timeline? 20 days.
20 days.
Where the FTA has reasonable grounds for requiring a period longer than 20 business days to consider this application, it shall notify the relevant taxpayer thereof. So FTA will let you know if they require more time. Where the FTA has approved a refund application in accordance with Article 26, it shall, within 5 business days from the date of notification, initiate the procedures of repayment to the taxpayer in accordance with the mechanism determined by FTA. So once the application is approved, refund application, in 5 days you get the money. FTA may defer the tax refund until the receipt of tax returns that have not been submitted at the time its refund application is received. So there were some tax returns, previous returns that were not filed. FTA may stop the refund and wait until the outstanding returns have been filed, until such time when all due tax returns are submitted. Any excess amount shall be refundable once such tax returns are actually submitted in accordance with the decree law. And I guess last one, if a taxpayer believes they are entitled to a refund, they can apply to FTA, and FTA shall consider the application within 20 business days. So basically, you can claim for refund. You can start the process, and FTA must consider the application within 20 days. or any approved extended period. Once the refund amount is approved, then naturally 5 days rule apply. Collection of payable tax and administrative penalties, which is Article 40 of the Tax Procedures Law. So, if a person fails to settle any payable tax within the specified time frame under the Tax Procedures Law and the Decree Law or administrative penalties, following measures shall be taken. FTA shall send the person a notice to settle outstanding payable tax and administrative penalties within 20 business days of the date of notification. So, once if if a person fails to settle any payable tax, so that if a person does not submit tax within the deadline, within 20 days FTA will send a notification. If the person fails to settle after being notified pursuant to Article 40, the Director General shall issue a decision obligating the person to pay the payable tax and administrative penalties, which shall be communicated within 5 business days from the date of issuance of the decision, with the tax assessment and administrative penalties assessments attached thereto. DGFTA issues that decision, and that decision must be communicated within 5 business days of its issuance to the taxpayer. The decision of the Director General regarding the tax assessment and administrative penalties assessment shall be deemed as an executory instrument for the purposes of enforcement through the execution judge at the competent court. So, it is an executory document based on which legal action or enforcement action can be taken. The tax is to be settled within 20 business days of a request to settle the taxes, and in the event of failure, a notice of demand requiring payment within 5 business days will be issued by the FTA. Very strict actually. So, once you get the notice, the tax must be settled within 20 business days. And in case that DG's decision come or notice comes within 5 days. In the event of a failure to pay a notice by the DG is deemed to be an executory instrument, or in other words, a binding obligation to pay. Assume X consultant
Excuse me,
owes.
sorry.
Yes.
Yes. If a taxpayer don't pay the taxes, will the FTA block their bank account, or will they issue a order to take the money from the bank account? Something like that is there.
So, honestly speaking, until now, I have not seen that, but FTA has powers to take those actions in case the delay has been, that the executory document also has been violated, like the DG's notification has been violated, then enforcement action can be taken. But I think there's a involvement of a judge that will be there. So FTA cannot directly block the bank account. By the order of a judge only they can block it.
But Australia, they can take the money from the bank account. It's called I can't remember the name of that order. They call something, and when they have put this order, they will block the bank account, and if they have any money, they will pay to the FTA.
Okay.
Yes.
It is tougher there. Huh?
Yes.
Assume
Yes.
ex-consultant owes 1 million corporate income tax for the December 24 tax period, and assume on 1 January 2026 the FTA issues ex-consultants a notice to pay AED 1 million. So basically, there was a tax liability of 1 million dirham for corporate tax for the December 24 tax period. So, and after 1 year, during, on the 1 January 26, FTA issues uh, a notice to pay that 1 million. Assume by 28 February 2026, consultant has not paid uh, the 1 million, and on 31 March 2026, the DG then issues ex consultants with a decision to pay along with the tax assessment. this decision becomes an executory instrument for enforcement by the court. That's where the court will come in. If it appears to the FTA that the payable tax may be at risk of being lost, the DG may request the urgent matters judge in the competent court to issue an order on a petition to seize the assets of the person that are sufficient to satisfy these amounts under control of any person whatsoever. Uh, Such assets shall be temporarily seized and cannot be dealt with unless the seizure is lifted by a judgment of the competent court at the request of the Director General. So now you can see that seizure can happen, but with the involvement of a judge. If the FTA believes ex-consultants may refuse to pay the 1 million dirham, FTA DG can obtain an order from a judge to seize ex-consultant asset. Okay, this we have read. So let us go to the next stage. Administrative penalties in case of a partnership, Article 41. So let us, without prejudice to any provision set out in the decree law 47, if multiple persons participate in a business that does not have independent legal personality, each of them shall be jointly and severally liable towards the FTA for any payable tax and administrative penalties related to such business. Very interesting angle. This is the example of an unincorporated partnership, if you really think about it. That multiple persons are doing this and the business does not have a juridical personality, then the people will be jointly and severally liable. Clarifications. This is Article 59 of the Corporate Tax Decree Law. How can a taxable person obtain clarification? Let's have a look at it from Federal Tax Authority. Person may make an application to the FTA for clarification regarding the application of the decree law or the conclusion of an advanced pricing agreement. Advanced pricing agreement, if you recall transfer pricing session, you can reach to FTA and agree on the transfer price between related parties, and that's called an advanced pricing agreement with respect to a transaction or an arrangement proposed or entered by the person. The application under this article, Article 59, which is what? Clarification, shall be made in the form and manner prescribed by the FTA at the date of writing. No manner has been identified. Now, so this is a repetition summary. We can look at the example. Ex-legal consultants can apply to the FTA for guidance on matters to be covered in an advanced pricing agreement covering service fees charged by it to its DIFC branch. The DIFC branch provides advice to DIFC clients, but with the assistance of staff employed by the LLC who are working in an office building in MR Square near the Dubai Mall. Can somebody criticize this question, this example? I would love to hear some criticism on this because this is not a valid example. What is the catch in here? Kalima, can you have a look at this?
I'm going through it.
So this is a branch. It's a branch, DIFC branch. The company is an LLC in mainland. Abbas, would you like to speak on it?
The branch, it would still be the same company for the purpose of the reporting.
Correct, yes. Good answer. Branch is merely an extension of the LLC. Their TRN will be one. So there is no transfer pricing implication ideally that should come because they're not filing two separate returns. It's one and the same return. Doesn't matter how much the branch charged from the LLC or what was the, there will not even be a need for an advanced pricing agreement here. Okay, guys. Article 63 and 64. So, administrative policies and procedures. Article 63. The administrative policies, procedures, and general instructions in relation to the requirements imposed on a person under the Decree Law 47 shall be issued by the FTA in coordination with the minister. So that's the Article 63 of the Procedures Law. Cooperating with the FTA, Article 64. All government, sorry, that's not. This is Decree Law, not Tax Procedure Law. Article 64. All government authorities in the UAE shall fully cooperate with the Federal Tax Authority to carry out whatever is required to implement the provisions of this decree law and provide the FTA with any data, information, documents, etc. For more information, there is, double taxation agreements, model tax convention basically. Articles 66 and 67, international agreements. To the extent the terms of an international agreement that is in force in the UAE are inconsistent with the provisions of the decree law, the terms of the international agreement shall prevail. Excellent. Does that make sense, guys? Which the example that I was giving for the double tax agreement previously, Vienna Convention and supersedence of international agreements. Here you have the proof. Article 66 confirms it. While not being specific, it is anticipated this covers each of the bilateral double taxation agreements entered into by the UAE with the individual country counterparts at the date of writing. This extends to 139 countries. I think it has exceeded now. Article 67, implementing decisions. Subject to the powers conferred to the cabinet under the decree law 47, the minister and the FTA. So three levels as we discussed: cabinet, minister, and FTA. They are subsequent subsidiary to the federal decree law, which is the top level. Shall issue necessary decisions within their respective powers to implement the provisions of the decree law 47. Cabinet may, at the suggestion of the minister, issue implementing decisions for the decree law 47. Then we come to cancellation of conflicting provisions, general clause. Any text or provisions contrary to or inconsistent with the provisions of the decree law shall be abrogated. So conflicting provisions in other laws should be abrogated, should become null and void. Article 69, application of this decree law to tax periods. This is Mr. Nazar, you should read this carefully. The decree law 47 of 2022 shall apply to tax periods commencing on or after 1 June 2023. Clear?
Yes.
Consequently, any taxable person having a period commencing on or after 1 June 23 is subject to the taxation of corporation. Article 70, I think this is the last article. The Decree Law 47 of 2020 was published in the official gazette. Uh, fifth, uh, uh, was published in the official gazette and came into effect 15 days following the date of publication. I think it was it 9 December or 15th December 2022 when it was published? But it was month of December. Or okay, we should start off again actually. Let me quick.
Sorry, I just had one small question. So right at the start when we were reading, and it mentioned that the authority can request information from the taxpayer.
Uh-huh.
So I remember that there wasn't any mention of within how many days that needs to be provided. So I'm assuming the number of days would be given in the notice issued by the authority.
Just once, hold that question. Let
Yeah.
me quickly go to the next,
Who is
shucks,
that?
man. Wait. I have to start this. So I'm
Yeah.
just writing correct, incorrect, etc. We will start from
Three.
without looking at it. I'm just clicking it. Okay, so that we can retake the test. Okay. Eh, okay. Take again. Okay. Now ask your question, Abbas, please.
Yeah. So initially, when right at the start of the course today, when we were reading that the authority can request additional information or supports, etc.,
Mm-hmm.
from the taxpayer with regards to the period for maintaining books of records, right? So
Hmm.
over there, it never mentioned within how many days is the taxpayer supposed to, provide the information. So I'm assuming the number of days would be mentioned in the notice issued by the tax authority.
Yeah, so just to answer your question, tax authority cannot arbitrarily put that time duration. Tax procedures law specifies that duration. You will have to refer, you'll have to go into tax procedures law and then see it. If I remember correctly, it is 20 days. I think
Um,
the time applicable is 20 days. But
I
we can,
recall there was.
uh,
Sorry, go on.
no, no, if you have dealt with a specific case, do let us know.
No, no, I haven't. I was just mentioning this because I remember that we had the 20 days mentioned with regards to provision of financial statements in the coursework over here, but not for anything else. So I was just confused. How many days would it
Right,
be?
right, right. It is not written in this course right now because tax procedures law is a detailed document. So if you, provision of information has been addressed there, and general rule is 20 days, but we
Okay.
can refer to and just to let you know, FTA may, facilitate the taxpayer by allowing them more time. They can say that, okay, provide, or maybe they will issue the notification, and in that notification they will provide the standard time, and then the taxpayer can go back to FTA requesting additional time, and that's the discretion of FTA. They can
Okay.
extend the time as well.
Okay. Thank you. Noted.
Okay, now let us start this. Select the correct answers to complete the statement that jurisdictions conferred upon the FTA under the Decree Law 13 of 2017 are compatible with the delegated powers. So, power contained in Article Dash of the Decree Law of 22 to operate and manage the UAE corporate income tax system and procedures. So, there is one of these articles, so it's a test of memory actually, but nonetheless, tomorrow if you are actually taking the exam in the British Council to with the ACCA to be certified for this, some tricks I use. Even if I forget the precise article number, we should remember like which of what are the initial part of the decree law and what is the latter part of the decree law. So if I don't recall it, the last articles usually talk about this jurisdiction of FTA and all that. So the most likely answer is 62 here. So it's a test of memory, which is, in the world now, this is not done.
It's very unfair.
Yeah,
And
true. I mean,
different ages. I
the
am now
entire,
I am now on
uh,
55,
yeah, so
and my
entire world,
memory, yes,
entire world has gone to open book model.
yes,
Uh,
yes,
op-
yes, open book model, yes, yes. This is
okay. The FTA may, before the expiry of the period specified in Executive Regulation 2023, uh, require the person to retain the records for a further period not exceeding 4 years in cases where he is required to do so. So we have to recall what were those 4-year cases. If the taxable person's tax obligations are subject to dispute between him and FTA, I think this was there. The tax agent must keep information that was 1 year, right? Documents and data related to any person that is or was presented by him for 10 years. That's wrong. Tax agent 10 years was absolutely not there, 1 year was. If the person is being subject to a tax audit and that tax audit has not yet been completed, so 4 years, yes. If the FTA has given notice to the person that it intends to conduct, that was also applicable. The tax audit has not started but notice has been given, 4 years will apply. The information matches the data contained in the original document and shall be available during the periods referred to in Article 44 of this decision. This doesn't make sense to me. So I have selected these three. If you have a different view, please tell me. So let us see. Correct. Okay, coming to the next one. According to the financial statement requirement included in Article 54 of the decree law, so FTA may by notice or through a decision issued by FTA request a taxable person to submit the financial statements used to determine the taxable income. I think this is correct. The minister may issue a decision requiring categories of taxable persons to always prepare and maintain audited or certified financial statements at the date. Okay, this also seems correct because but the decision came, if I remember correctly. There is a decision which may, identifies who are required. This is not correct actually. Abbas, what do you think?
I'm not sure on this one.
It's correct. It's
I don't
correct.
recall this one.
Should be correct.
Correct meaning you are saying ticket.
Yes, ticket. Yes.
Okay. Taxable person to always prepare and maintain audited or certified financial statement. At the date of writing, no such decision has been published. I
Yes,
think the
correct.
decision has been published. Categories of taxable person to okay, maybe from this course perspective it may be correct, but in reality this is not correct. For the purpose of Article 54, FTA may request a partner in an unincorporated partnership. Absolutely, yes, this is
It's
correct. I have doubt on this because this decision has been published, but let's see. Ah, correct. So this is an older version. That's what I was saying. This decision, just for your information, this statement is now not right. A decision has been published.
okay.
So anyways, let us go to the fourth one. Taxable person must apply for registration with the FTA in accordance with the provisions of the tax law. A registrant must include in his tax registration number in all correspondence and transactions with the FTA and others in accordance with the provisions of the tax law. Absolutely correct, right? uh, Apply for the okay, then inform the FTA in the form and manner prescribed by the FTA of the occurrence of any event that might require the amendment of information related to his tax records kept by the FTA within 5 business days from the occurrence of such event. uh, okay, do you think this is correct?
Isn't it 20 business days?
Yeah, I think 5 business
Then
days is wrong. 20 business days is correct.
I think
Yeah, Abbas, you want to say something?
no. I just think it was five, but maybe I could be wrong. I just thought maybe it was five, but okay, could be wrong.
Okay. Apply for deregistration in accordance with the relevant conditions of the decree law. Correct. I think, okay, let's go with this because it was 20 business days. Correct. So it is, yeah, Abbas,
Yeah, 20 business.
20 business days. Okay, let us read this. Select the correct answer to complete the following statement. A registrant shall within X business days notify FTA of any of the following changes to the name, address, articles, association. I think easy answer.
20. Yes.
Okay, let's read the next one. Select the correct answer to without prejudice to any provision set out in the decree law. If multiple persons participate in a business, I think jointly and severally, a business that does not have independent legal personality, each of them, we read it just in the last,
Yes. Yes.
uh,
Yes.
uh,
First one.
each
Yes.
of them shall be jointly and severally liable or responsible towards the FTA for any jointly and severally liable. And what is the next? The tax return requirements included in the decree law require that a tax return shall include at least the following information. Tax period, absolutely. The name, address, etc. Yes. Date of submission of the tax return. Okay. Accounting basis, yes. Date of submission of the tax return. Yeah, tax return. Okay, fine. The taxable income for the tax period, the amount of tax income claimed under Article 44 of the, what was Article 44? Anybody recalls? The amount of tax income transferred under Article 56 of the Decree Law 6, Decree Law 6 of 2022. On tax income transferred. I don't know about this one. The available tax credits claimed under Article 46, fine. Corporate tax payable for the tax period, yes. Which ones did we not? Date of submission of the tax return, okay. I mean, logically it should be the amount of tax income transferred under Article 56 of the Decree Law number 6 of 2022. Decree law number 6. I'm going to uncheck this. I don't know. This is not. Is it correct or incorrect? Incorrect. So what is it? This. Okay, this was incorrect, so we left it correctly. The only mistake was this one. The amount of tax income claimed. Tax income claimed. Tax income claimed. Oh, that's wrong. Okay, let's look at the next one. Select all that apply. The requirement of a person in relation to preparing and submitting the tax return included in the tax procedures law 28 require that every taxable person shall prepare and submit the tax return to FTA in accordance with the provisions of the tax procedures law and tax decree law of 22 person in relation to preparing the submitting the tax return included in the. Okay, what next? Settle payable tax within time frame. Absolutely. When paying any amount to the FTA, specify the type of income and loss to which the amount relates, and the MOF shall allocate. Yes, this is also correct. Right? Let's check. Oh, incorrect. Why? Which one? So what was the requirements of a person in
We
the.
don't mention the type of amount, but we will
Yes,
specify the period, tax
Ah,
period.
okay. When paying the amount FTA to FTA, specify the type of income and loss. Okay,
yes, it's wrong.
it's wrong. Okay. What is this one? A taxable person must settle the corporate tax payable under the decree law within 9 months. That's an easy one. From the end of the relevant tax period, right? 9 months, September. Then we come to the last one, true or false. Tax and other amounts due to FTA in accordance with the decree law 47 shall not have precedence over all the funds of the debtors or persons shall not have precedence over all the funds of debtors or persons who are obligated to remit them to the FTA by virtue of the law. What the hell does that mean? Let us read this. Tax and other amounts due to FTA in accordance with the decree law shall not have precedence over all the funds of the debtors or persons who are obligated to remit them to the FTA.
It's
Uh,
false.
huh? It is
It's
false, na?
false.
It is
False. Yes.
false. I think
Yes.
it
It's
is false.
false.
Okay, let's see. Yeah. Tax obligation takes precedence.
80%.
Okay, so
Pass.
we have understood these, what else is there? Okay, great. Thank you very much for joining today. Inshallah, we will reconvene on the next Sunday, 10 o'clock. Thank you, guys.
Thank you very much.
Assalamu alaikum.
Thank you very much.
Hello.
Thanks.